right, let's get going. Got a lot to talk about, a lot of good stuff, a lot of Twitter stuff. Um, and we started out with some good music. I get really pumped with the good music. Usually when I get on the treadmill, I watch TV and or listen to podcasts. Obviously, most of the time when Niels mentions me on the podcast and he's going to say something, or Rob's going to say something, they make this joke that is, well, Jerry, one of our friends is on the treadmill. When he hears this, he's going to fall off the treadmill. And it's ironic how often I am on the treadmill when they do say that. But, and I do enjoy the treadmill indoors, 70 degrees, and listening to the podcast. I really just enjoy listening to Richard's podcast, and then watching TV, Sports Center, whatever, and then movies. But if I go to the music when I'm on the treadmill, my workouts are so amazing, so much better. Not amazing, they're better for me, right? So maybe we can do the same thing here. I'm getting really fired up about Clubhouse. Not Clubhouse. My wife calls it Clubhouse. No girls allowed. Not true. And she has her dogs and her coffee. She's good, but she still likes to make fun of me. But I think this music is going to help me get going. Um, so I also wanted to mention, sometimes I post these tweets that it looks like I agree with them, but I really don't agree with them. And like yesterday, I wanted to post these tweets about diversification, which obviously I don't agree with. It's coming from two groups that don't trade trend following, Munger and Spitznagel. And I thought it was just funny because I wanted to remind myself to talk about the difference between diversification for trend followers and pretty much everyone else. So, and Richard's already mentioned some of these things, replication. It's easy for trend followers. Anyone can kind of become a trend follower if you're really into it and dedicated. You can be somewhat successful. Uh, and these other guys, they have these specific ways of doing things, not even close to trend following. And so they don't like diversification, but we know diversification for us is just quite amazing. And it's really a large part of what makes trend following successful. And since a lot's already been said about these two tweets and on Twitter, I will just say that the one thing I did want to bring up is even if you trade 300 markets versus 50 markets, I still think that it's better to trade 300. You get the outliers dispersed over the data more evenly, maybe. But you also have to remember that, in my opinion, the trend following trades, they all have the same expectation. So there's no lessening of potential profit when you add markets. It's just all goes straight to the smoothness. And so we don't try to do too much when it comes to smoothness as far as volatility and correlation management. But obviously, I try to do something about the choppiness and the letting profits run, the loose pants, as well, with the diversification piece. So that's why it works, because theoretically all these trades are the same. And Munger's top 10 ideas, according to him, I don't doubt it, they're not similar. Um, so it really matters to him and his success that he doesn't water down things. We don't water down. My soybean breakout has the same expectation as my Swiss franc breakout over time, over all the data. Okay, time to add some speakers.
Good morning, Jerry. Good morning, Brian, Moritz, Richard, Alp, and all the guys I see here. Of course, I'm very happy. Hi, Brian. Yes, of course, I'm very happy to be here. It's a very consistent thing for me. And this week, few days, I was in the tent, was reading Mark Aurelius there in that tent, and I want to say that I found in, as I expected, I found in a lot of things about our transforming trading in the book Meditations of Mark Aurelius. Right now, I have read that we must be very consistent, like stars, to be successful, and that the laws of nature are unchangeable, the main laws of nature, and I say this every time. So, also, I have listened a few conversations with Jerry, and it's always, I don't know even, I know why, but emotionally, I feel that maybe I listen something great the first time, something like this, every time when I listen conversation with Jerry. And it's really great for me, every time. And I listened, I doing my notes. Jerry and Michael, since Jerry in the some podcasts, and I will publish all the notes, of course. So very good week. Also, it was a very big storm in that tent in that beach, and it was a great reminder. Maybe people said that maybe for 7 or 8 years there was no such storm in this place, and the landscape changed very much only in a few hours. It's a great reminder, I think, that the convergent strategies are not safe. And if you're divergent, so a lot of tents were near the sea, and my tent we were near the sea, to be honest. And when the storm started, and it was unexpected event. And if we think in our 24 way, if we live in a tent near the sea, it's 100% that there will be a big storm. But people don't think about this. And even I didn't think about that these days will be the storm that will the strongest storm in maybe 8 years. I was only a few days there. So great reminder also. I like to find, to see, to search, try and follow in our principles everywhere. And I see this, and I'm happy because of this. So let's get started. My happy hours are in the beginning, was waiting all the week. Okay.
G'day, Oleg. G'day, Jerry. I love this start to the spaces. I love your intro, Oleg. It's fantastic. Jerry, hope TFPN's doing well. And look, I know you mentioned in last Friday's spaces how you're a bit disappointed with your performance with Niels and Alan, but look, I get like that when I'm on podcasts as well. I think, oh God, if only I'd said this, or oh God, if only I'd say that. But seriously, I had a listen and I went through it. And look, you're firing on all cylinders. I love that podcast you did with them, even though you might have been disappointed you didn't get it all out there, but I thought it was excellent. And look, I was wondering if in this session we could perhaps discuss Florin Court, and the idea being in that in our discussions, Jerry, where we talk about, is it best to trade stocks that are undiversified or stocks that come from companies that are highly diversified? And we say, well, ideally, we're looking at stocks that have unique characteristics. So we don't want them to be diversified because we're targeting these outliers. And if we're trading companies that are highly diversified, they're already flattening their performance or equity performance and sort of reducing that outlier potential. We want to look at these unique characteristics. And in relation to Florin Court, where they are aggressively adding markets from new emerging sectors, my gut feel tells me there's a similar principle at work there, where these infant markets, these emerging markets, in terms of what Florin Court say they offer better trending conditions. Now, there is something in me that says they might be onto something. I don't know the research. I haven't done the research. I know Moritz and others are looking into that. But there's something that tells me that these infant markets, before they get participation from a huge variety of different players that start stifling that outlier potential, in the early stages of their life cycle, they probably do offer significant trending potential. And I'm looking at new products coming into the market, like cryptocurrencies and things. They boom when they enter the market because no one's really aware of what they are. There's a lot of hype associated with it. They go into these exponential trends early in their life cycle. And I was just wondering if some of this discussion tonight or today can be look at Florin Court and discuss the pros and cons of it. And what do you think about that, Jerry?
Yes, I agree with all of that. I agree that we should talk about it. I am jealous. I've been on record many times. I don't even talk about Florin Court, which I talk about them often, unless I start by saying I'm very jealous of them. Now, I love my stocks, and I think that they're wrong. He criticizes me all the time. He doesn't say my name. He criticizes CTAs are not good at trading stocks, but he also says they're not good at trading stock indices. So not he doesn't criticize me by name, but he criticizes what we do. And so, however, I love the stocks. I think he's wrong, and I think, but I am jealous that he trades a lot of good commodity markets. China commodities. I would love to trade those. He gets into a lot of talk about most of the markets I think that he is trading is they're not exchange traded, possibly an issue to be concerned with there. Um, they are over the counter. They they sound interesting. I don't know about them honestly. He overstates, in my opinion, just ipso facto. They're better because there's not many people out there trading them. I think he's contradictory in that he brags that he doesn't trade any normal markets like U.S. sugar, U.S. cocoa, any sort of normal CTA market. I forgot he has terms for all of this alternative market CTA, and he has kind of a funny negative term for all the rest of us who trade the normal markets or the usual markets. He does say he trades sunflower seeds, which a lot of us trade as well. I just think it's a marketing thing for him where he overstates. Like it's great to trade the 500 markets and it's great to trade the 300 markets like I trade. I never will say I don't have any evidence, and I don't believe it's true. I started out this podcast by saying all the trend following markets have the same expectation. So he's saying not true. I found these other markets with these characteristics that I've come up with that make it much better. 2x he says 2x the standard deviation. And probably on Niels's podcast, he said standard deviation is not relevant to CTA trend following outlier distributions. And this is what I said to Niels and Alan. Like all the CTAs except Quantica, I like the way Richard pronounces it much better, talk bad about the Sharpe ratio on Niels's podcast, but then later in the podcast went to compare their Sharpe ratios and talk about Sharpe ratios as if they hadn't just said that Sharpe ratios are not good for the type of trend following trading. So I just think that I'm a little skeptical, and I think you should probably philosophically have an opinion on this before we get Moritz's research, Richard, of the likelihood of these markets knowing what you already know, that these markets that don't have a lot of participation from speculators, maybe, I guess they probably have a lot of participation from commercial traders, hopefully, or where is the liquidity coming from? That they would, given you what you know about markets and trending, and you have said many times, as I have, that all markets have this tendency to have these endogenous trends, that he would stumble across this idea that it not only is he trading the best markets that are going to have the best trends, but he doesn't trade the other markets that we all trade because his markets are so superior. And it's very unique markets. Thailand interest rate swaps or something like that. I mean, crap you've never heard of before. And then I'm skeptical of my own idea as it relates to saying, stay away from heavily diversified equities. I mean, I believe that to be the case. And I believe that if you put up these criteria, like I do, okay, so like 10 billion below 10 billion market cap, unique companies, hopefully that don't have a lot of diversification, one line of business, whatever your criteria, fundamental discretionary criteria is in choosing these stock portfolio, the key to that is stick to it, and then stick to this fixed portfolio, and you'll be fine. And when you see multiple examples of outlier trades coming from a group of equities that do not have these characteristics, calm down. That's fine, because Nvidia is not going to be one of these stocks, and it's hasn't had a huge trend in terms of ATR. Uh, well, had a decent trend in terms of ATR, but it's definitely possible for crappy ideas to have their day in the sun. And you just have to wait a while longer for your better ideas to show themselves to be better. But the key to all of this is just one thing to think about, and that is a consistent application of whatever you're doing. Consistently trading the breakouts, consistently trading that system of yours, having a fixed universe. And if you're going to add stocks, because sometimes you have to, every year I have to add 4 or 5 stocks because some of my stocks are getting bought out or merged, then apply that same strategy below 10 billion, uniquely diversified, hopefully in some way, not a diversified business line, probably hard to be if it's you're like a $2 billion company. I have a lot of the ones and twos as well. And just consistently apply those rules and put blinders on and don't get jealous of NVIDIA. Yeah, so I think that's what I wanted to say. And I love Florin Court. I love that they're out there doing that. I just I think he overstates his advantage. What do you think, Richard?
Yeah, I think you might be right. Look, just from my understanding of markets, I tend to view every market as having a life cycle. And you remember those life cycle curves of products where you get this sort of initial conception of the market, and then we get an explosion or an increase in the growth rate of that market, and then we get a plateau effect, and then we might get a decline, then we might get a resurgence, or we might get a continuous decline. So that there's this general life cycle. And the way I see that in terms of the mechanics of participants is that in the early stages of growth of a market, there is an explosion in non-linearity, and that's because when a new market comes into fruition or a new idea comes into a fruition, there is a take-up of that idea by the people that are ahead of the 8 ball. They're the ones always looking for the new idea. They jump on, and then they'll find certain applications that can be used for that particular idea, and then we get an explosion of other participants coming in because it has further applications. So you get this sort of non-linear growth spurt, typically in new markets while they're finding themselves, and a lot of that is a hype. A lot of that is from a rush of investors looking for the new great idea, and there's no substance behind it. But there tends to be this non-linear growth spurt. And my gut feel tells me that is a perfect environment for trend following, because when markets get more and more mature and more participants start eking out their different forms of edges out of that market, the competing pressures of all of those different models that are extracting their arbitrage. So the market becomes dominated by these convergent models. And the divergent traders amongst that group is a lot lower in abundance as markets become more mature. But in the infant stages of a market's development, I think there is there's a greater balance of or greater representation of divergent traders in that startup phase before these new convergent traders with their ideas of how they can buck the trend and take mean reversion and all of those opportunities, the hedges and all of those sort of things. When they start interfering with that, what it does is it means that the trends still persist, but they become more spread out. So we get periods of, in more mature markets, I tend to think we get periods of more predictability punctuated by these periods of transition. But in the growth markets in the initial stages, I think it is dominated by nonlinear growth trends. That's my gut feel. I can't back it up. Haven't done the research. I'd love to know what Moritz thinks, because I think he's already starting to do some research in that area.
Hey, Richard. Good morning, everybody. Honestly, I don't know about these markets. I'm definitely not going to say that they're superior or better than the stuff that I trade today. There is research. I'm not sure to what extent it's been backed up, but Perry Kaufman, in one of his new methods or new market methods books, has defined a noise ratio. And what he found is that markets which come into existence and are young, so they're only just got listed or liquidities, just building up, that these markets have less noise. There's more structure to them. There's a better signal to noise ratio, and he uses all sorts of statistics to measure that. It's like, how smooth does a market trend, these type of things. So he kind of says, yes, these newer markets, they are less noisy, or these let's call them alternative markets, they may be less noisy. But by the way, in Turkish interest rate swaps, I don't know if they're less noisy. I really don't. I can't say yes or no to that. I mean, this may not necessarily be a small market. It could be a very large OTC market. It's just that you and I don't observe that because it's not a listed futures contract, and we therefore don't know. So this market could be noisy. And then what he says, the research goes on to say, well, as markets develop and they mature, then over time they become more noisy or noisier because all sorts of people start to participate in it. And one example, for instance, is the S&P 500, or say the DAX index, right? These are the big markets today. Apparently 20, 25, 30 years ago, they were noisier because it was more the institutional players trading them, or people that had a hedging need. They were using these futures markets. Jerry was trading them back then. Okay, fine. But now, 30 years later, you have kind of everybody trading in these markets on interactive brokers, retail, insti, high frequency trading. Everything is kind of ARPed out, and therefore there's a lot of noise and not enough signal. Okay. Then I step back and go do you really care about this? Would it, honestly ask yourself, would it influence your choice of deciding to trade a market, whether it's noisy or not? I mean, you could say cocoa has been very noisy. It hasn't made us a lot of money. Now it's making us money, but we're still trading it. We're trading cocoa because there is no other market like cocoa. Yes, there is one in London. There's one in New York, and we trade them because they're so diversifying. So I go by diversifying properties. If I can get sunflower seeds, fantastic. I'll trade sunflower seeds. The question whether sunflower seeds is noisy or not is really secondary to me. Even if the market is noisy, I think that with our technique of keeping losses small and letting these winners run occasionally, we're going to be making money even from the noisiest markets in the world. So that argument really, to me, is a little bit nude. What I found very interesting, and I was kind of, I know, Jerry, you and Niels, you brought it up on the podcast when you were on Niels's podcast on markets being more volatile around turning points. That I found a little. Well, I listened to that. It's I don't know. I have absolutely zero data to back that up because I don't know what a turning point is. I can only figure out what a turning point is in hindsight, and even then, it's not clear. You define. We all on this podcast, we may optically define turning points in very different ways. For some people, a slight setback is a turning point, and maybe for somebody like me, a turning point is when the trend reverses for weeks. But the observation that around turning points, markets become more volatile, I don't know. It may be a convenient argument of the dynamic position sizing crowd to defend their posture and say, oh yeah, look, I mean, there's obviously a benefit in vol controlling and vol targeting, all that type of stuff, because at turning points, markets become more volatile, and therefore we'll have the upper hand and an advantage because we'll be reducing position size as the trend starts to move against us. I really don't know if that's true or not. I'd like to see somebody prove it to me, like do a real, show me the data, define exactly what a turning point is, and then we can have an argument about this. If somebody just says it like this, I think it's, could be right, could be wrong, but I'm not just believing that. And then the other thing, and then I'll stop. One of the things that are a little bit too short-sighted, I believe, in my opinion, when we have these discussions about dynamic position sizing, and they're now like, Niels is on it, and he's making some arguments which aren't wrong, saying like, look, I mean, if you have these trends and they like say to the top side, right, and they happen with low volatility, then we're becoming larger. We're making more money from the trend. Whereas, Moritz and Jerry and Richard, they only sample the volatility initially, and it may be timing luck. We may have a too small a position on compared to the other like dynamic position sizing guys. Okay, get this. And then, it goes like the turning points, all that type of stuff. But really, I think what's so important is like, if you dynamically adjust, if you must, right, if you can't resist, how do you actually do it? Because, Niels goes on to say, oh, we're doing it more on a VAR-based framework. And maybe other people do it on a standard deviation-based framework, so using volatilities. Maybe yet others, I don't know, use average true ranges and say, look, if the average true range of a market starts to become larger over time, then I need to reduce my position size. This is really not all the same thing. When you think about it, when you take a crude oil position from $50 to $100 and you're long, the average true range used to be, say, $1 and it's now $2. Obviously, crude oil is now twice as large because it moved from 50 to 100. The notional contract size has doubled. And this position will, in all likelihood, now have a much larger foothold in your portfolio and really move the needle relatively more than other positions that you have on. If you reduce it now because you've spotted that the ATR has gone up, well, you're taking a profit, you're executing a mean reverting trade. That's one thing. But not all of these vol control people will do it the same way. Like somebody that uses standard deviation will probably say, well, the standard deviation of crude hasn't changed. In percentage terms, it may have the same vol at 100 than it has at 50, and therefore execute no vol controlling trade. The thing is, and this is what I'm working with my friend Moritz on, is to test all these things. We will write them up and you will see them. But I mean, I'm really intrigued. People talk so loosely about this, but there's so much more behind it. Like the methods that you're using in order to execute these trades. Look, forget about it. We always talked about, they're not cost free. You pay for the execution, all that type of stuff. But depending on how you do it, you may get very different results. But in all likelihood, and this is really I guess it's already more than a bet that I'm making. I cannot see how they're not tricking you into taking profits too early and introducing a mean reverting behavior into your trend following trading system. And that is what creates that smoothness, that it reduces your skew. It costs you more money. And I'm willing to bet that when all is said and done, we can show that we're making more money without that stuff. Raw dollars.
And I have done it's very complex and interesting topic. I have done a big research on this topic a few months ago. And I want to say that here I'm on the Jerry and Maurice side. That, of course, on the one hand, I see that new markets, they have more ability to be branded markets, less noisy markets, and a lot of logic, my own logic behind that. Had even a big research, my own research. But first of all, we are trend followers, classical trend followers, and first of all, our philosophy comes first. And to aggregate our portfolio with these new strange markets I think it's not our philosophy. And as Jerry said that first of all, I add markets because of diversification benefits. But I think it's we must have different. Jerry also said that Nvidia have a very big trend, and we can see in all the markets very good moves, very good outliers also. And so I think, first of all, our principles and one of the main our principles is the massive diversification. And so if a person creates portfolio with only new markets, I don't think that it's the better way. Of course, if we apply turn system to every market, it will turn following way, as Jerry says, turn following systems improve all the markets. All the markets will make money, but and newest markets will make maybe even more money in the short term and the nearest few years. But we don't know the future. We don't know a lot of things, but we have our core beliefs, our core principles, and first of all, we must stick to our core principles. And as I have said a few minutes ago, it's a massive diversification across all the markets we can trade in all the sectors. So here's my point.
You make a good point there, Oleg, because what trend followers are specializing in is what we refer to as absolute momentum. These methods we've been describing, these overlays, is what I'm almost referring to as a cross-sectional momentum approach. In other words, it's looking at the spatial correlations that exist in a portfolio at a point in time with the assumption that there is information there that can make you better manage risk in your portfolio without compromising those outliers. Now, I personally feel that outliers are a consequence of serial correlation. We can get spatially correlated markets that all sort of move together at once. But I think the primary driver of serial correlation is this time-based evolution of a return path. And so if I say to myself, what distinguishes Amazon from another distributed seller? Why is Amazon so big? It's not these spatial correlations that are important here. It's a sequence of serially correlated dependencies that have been created by Amazon from its inception to the point in time now, that at these particular nodes, we've had these explosions in non-linearity. So the first step was they were a bookseller. There was probably no significant growth in Amazon. Then when they got onto online distribution, suddenly that gave them an exponential explosion in non-linearity. Then when they got into distributed marketing, there was another explosion of non-linearity. These are all sequential steps in a pathway that creates this non-linear result. So when you get these serially correlated non-linear pathways and you put them together holistically as a portfolio, that's where you see, if you look spatially in that cross-section of that portfolio, you are going to see correlations, but they're fickle correlations. They're not necessarily causative related correlations. You can only see the causal structure when you look at it from a serial perspective, in time evolution. And that's why I think that trend followers, the reason we focus on this absolute momentum idea is it's time series momentum that's important to us. If we start adjusting our models on the fly with almost cross-sectional tactics, or as Moritz puts it, sort of mean reversion, including mean reversion, and I'm thinking, well, it's probably including cross-sectional momentum into it. We're compromising the philosophy of our dedication towards absolute momentum.
Richard, can I ask you something? Do you think that when there is a cross-sectional period, like for example, when the Fed put the interest rates in zero, and then everything started to, I don't know if to be an outlier, but many things were like Amazon because of an external economic stimulus. Do you think that's worse for the trend following strategy? At least in the results, the past decade was bad, and at the same time there were a lot of assets, mainly in the equity sector, to be fair, that were outlying, so to speak. Do you think that when that happens to all or many assets at once, that's not so good for the strategy?
Yes, so in an ideal scenario, as a trend follower with a diversified portfolio, you do want uncorrelated return streams, but each of those uncorrelated return streams has the ability to deliver non-linearity. As a composite, the non-linearity would be an expression of whatever the return streams and how they interact together, amplify that into a non-linear result. Now, you do not want, you look, whilst we accept that there can be periods of time where a lot of markets are highly correlated, you can find that you get clusters of non-linearity at points in time, like 2008, 2014. There are certain things at a cross-sectional perspective which flow across sectors, across markets. There's these liquidity cascades going across markets. These are particular regimes where the entire system of markets, because all of these markets are connected. They're connected by virtue of the fact that people have their money, in one market. They might be using leverage money in one market, funded by money in another market, etc. There are these cross-sectional linkages that do exist in markets, and we can find that markets do exhibit this strong correlated property during periods of extreme where a lot of them are doing the same thing. That shows that there's a deep correlated dependency in time to all of those markets. However, there are periods of time also where we get non-linearity arising in discrete markets. You can see those ones in serial correlation. The Amazons, the Teslas, the Modernas, these things are individual nonlinear dynamics that occur outside of the entire collection of markets properties. And it's more a case of we must recognize that everything fundamentally is correlated. All the markets are fundamentally correlated. For instance, the way to put all of our financial markets out of action is to destroy this planet. If you destroy this planet with an asteroid, you'll suddenly find, they were all correlated. But no one takes that destruction of the planet seriously with their risk assessments. But if you look wide enough, you can see everything in this system that we call this planet is correlated, because it all evolves from a simple rules-based process, and in an evolutionary manner, the system gets bigger, more powerful, more self-autonomous. It splits up into subsystems. Each subsystem becomes more autonomous over time. So you get these systems within systems within systems within systems, and they all are correlated to varying degrees. So you can't escape this correlation. That's just how a system evolving works. But if you look fundamentally at serial correlation, and you're looking at ideas that are distinct, logically distinct ideas that don't have a common dependence. So in other words, if your choice is, I've got three markets here. I've got fish, I've got Ford, and I've got Tesla. If you have those three markets, you say, I can only afford to trade two of those markets. Which ones am I going to trade? You would have to logically group your Ford and Tesla together, because they've got a closer correlated proximity than fish do to Tesla and Ford. So if you look in an evolutionary framework, and you map out the evolutionary pathways, which none of us had time to do, but think of it logically. If you've got a choice, like Jerry, when he selects his universe, he's saying, potato chips. I don't have anything in my portfolio that is closely related to potato chips, seasonally, crop-wise, whatever. I know that it is distally separated in a correlation landscape from the rest of my portfolio members. That is a logical basis to deduce correlations, which I think is more sound than relying on a statistical point in time looking at the correlated relationships between potatoes and Tesla. You might find that they're correlated, but there actually is no causal connection. It's just the way it works out. So if you look in terms of causally correlated properties. How distinct are they? How unique are they? Are they true diversifiers? I think what Jerry's doing is the right approach. You do that using logic. You create your fixed universe using logic, a sound logic. Don't trust your correlation results you get at any point in time. They're fickle, but use your logic to decide that. And once you've got that, those hopefully that uncorrelated ensemble of markets as your universe you're going to trade, because logically they are distinct, totally separate to each other, you know that they all will have correlations to a degree, but they're going to be weaker than the rest. Then as they serially evolve, they will develop, hopefully, or all of them at any point in time can deliver these nonlinear properties, because we don't know where the next explosion in growth is going to be. It might be from a blockchain, it might be from AI, it might be from here, there, whatever. But if they do express these nonlinear properties, when you combine these things together, those nonlinear properties are preserved, and often they are amplified in a serial correlation relationship. So that's how I'd view that.
Oh, yeah. If I could just get in and ask you a follow-up to that, which I loved all of that.
Hey, hi everyone. Glad to be here. I'd like to bring back the topic to the alternative markets. I'm levering up on work done by Moritz, definitely. I started researching them. First thing, it's really hard to get the data from them. It's not everything is available. It's the time series sometimes are not that long. They're not that old. Some of these markets are new. They started trading a couple of years ago, and some of them stopped trading at all. And then you don't have that much data to research. You cannot trust that much. What's the high and low? What's the open? I'm focusing my analysis on settlement prices, and this comes along with a lot of difficulties in itself. And the thing is, these markets are so illiquid that it's funny because they don't present that much of a volatility for a couple of days, and then all of a sudden they jump to a new level, and you can't even figure out what's going on. It's different from more liquid markets where price discovery is more, continuous. It's not that discrete as these alternative markets, and this comes along with some difficulties as well. But the thing is, doing all the hard work of treating the data and making it suitable to run any back test on, I found something that shouldn't come as no surprise to everyone here. They have all the same expectations, exactly as Jerry says every time. And perhaps there is some outlier that may kick the ball out of the park. But that can happen with any other market that we trade, being it alternative or conventional. It doesn't really matter. The thing is, the average trade is about the same as we should hope to find in any simple system. The hit rate is about the same. About 40% of the trades make money. The average win is similar to what we find in conventional markets. The average loss is similar. I mean, it's not that much different. I'm not really sure if the thing is alternative markets that Doug is talking about, that are different and make more money from a trend following perspective, or if the system that he is employing on these alternative markets. Because honestly, I can't see that much of a difference. I can't. And especially because the sample is so much smaller, you can't really draw too many conclusions on them. So I can't find that much of a difference. I hold to my guns that the more markets, the better. It's simply you're simply giving your system a chance to flourish on different fronts. That is much better than trying to trade only a couple or a handful of markets. But that's about it. It's not that because they're alternative, they're better. They're just more.
I fully agree with that. First of all, we must we must understand the liquidity of the market. So, not liquid market, liquidity can be a very big issue if we face some crisis situations or close similar to crisis situations. Liquidity is really important thing. And of course, we must think about
A plus to Bruno. He's always getting A's in my class. Compliment the teacher, you're going to get an A. I wanted to get back to what Richard was saying. Oh, yeah. Okay. Thank you for all those nice things you're saying about the way I choose stocks. And I think you tweeted some of this as well, which I honestly wasn't able to follow a lot of your tweets yesterday. So at some point, if we have time, if you wanted to pick up on those and explain it to us. I love to like all Richard's tweets, and they're amazing. And if he has like 10 tweets in a row, I'll like those 10, right? People are always asking me, what is the best book? Where should I go to learn about trend following? I'm like, look, it's not going to get any better than Spaces, Our Spaces, and Top Traders Unplugged, and then Richard's website and Richard's podcast, okay? However, honestly, I can't like Richard's tweets if I don't understand them. So if I don't like them, it's just like you could probably say, oh, crap, how does Jerry not understand that? Or, yeah, I'm like Jerry, I don't understand that one either. So just to be intellectually honest, I just find it difficult as much as I'd like to like all of his tweets. Sometimes they're above me. Okay, this is a question I want for Richard, though. And that is, as you go on and say the way you're okay with the way that I choose my stocks, and they are nothing is really correlated with the French fries or the lithium or the uranium, except kind of other stocks. And this is how I'm doing it, which is totally accurate. And all my stocks, I only show our positions on the ETF where we have a position. So you haven't seen all of my stocks because some of them I'm flat. Okay, but as you see in those stocks, this is exactly what I'm doing. And I'm very careful to choose the perfect 150, right? And however, I do trade Brent and WTI because I can afford to trade 300 stocks and I can afford to trade WTI and Brent. I have enough AUM. So how does a person be so careful with his 150 stocks? And I would never trade the equivalent of WTI and Brent if it was two different stocks. I don't. And I intellectually say, yeah, don't do that. You only have 150. But in commodities, I guess I have 55 commodities, and it's almost every single one except the ones that Florin Court trades in the Chinese commodities. But I'm totally perfectly fine with trading WTI and Brent. Richard has told me that's totally fine. He uses that as a perfect example of two markets that are highly correlated that we do trade because there is precedent that one has had an outlier at the same time that the other one did not. Is this a remnant of me starting out as futures first and trying to get to 100 markets? And the way to get to trading more markets is to trade WTI and Brent. But then when I get to a point where I can trade as many markets as basically I want, but the outlet for those additional markets is going to be stocks, to where I say, okay, I'm going to be very careful choosing these stocks, but I'm not going to get rid of WTI or Brent because that's what I've done from day one. What do you think, Richard?
Yes, Jerry. So the example with WTI and Brent, what that's saying is that they are highly correlated. We know that. But the models that we use to trade these things, whether they're highly correlated or not, we're saved by our models because our models have these tight stops, these trailing stops Those are the things that protect us from the adverse correlations that might occur with other models that don't have those techniques, like no stops, and they're using correlation measures at a portfolio to manage their risk. They potentially could come undone trading WTI and crude. We've got a little safety net built into our models. But ideally, in this scenario of trading markets, when we're dealing with finite capital, ideally, we want to trade uncorrelated markets. And the reason for that is that we don't want our outliers necessarily to all occur in one location in time and space. Ideally, over the term of a 20, 30-year time period, we want as many outliers as we can distributed right along that 20 to 30-year time horizon. That lifting power of those outliers along that entire horizon is going to maximize compounded wealth over time. We're not going to get the compounding effect being diluted with drawdowns. If we can obtain those step-ups progressively distributed along that time frame. Now, to do that, we can either use models to do that, but also we can use a selection of markets we wish to trade to do that. The way we select our markets is not through using probability statistics of correlation. The way we do it is to think in terms of causal evolutionary networks. This is the stuff that gets you lost. But the way to think about it is think of the development of life on Earth. When you see those evolutionary maps that talk about how, we start at cells, we go to bacteria, we go to algae, we go to trees, we go to chimpanzees, we go to humans, all of those sort of things. So that evolutionary network tells us that certain species die out, certain nodes die out over that evolutionary network. That's exactly the same as traders dying out over the course of evolution of a market. It's a risk of ruin. It's where the evolutionary adaptability of that network dies. And so you get those links that end. But you'll notice the things that are still surviving today have got a network of relationships that go back in time to common elements. So we split, with chimpanzees and us split at a primeval being called Homo erectus or whatever it was back in X number of years. That is, together, we are more correlated, chimps and humans, than, for instance, humans and fish. Because when you go back through that causal network, you'll find that fish and humans had a far more, their common point of origin is far more back in time. Now, the thing about these networks, these evolutionary networks, is we've got a track record of stability looking at the foundational things that create those nodes as we progress through time. Those foundation things are very, very stable. So if we look at an evolving galaxy or an evolving solar system, we see that the fundamental units of that are the stars, and then we get the planets. And then within the planets, we get the life forms. Within the life forms, we get all of these little branches coming off. Each of those networks come back to a common ancestor, the planet. That planet is incredibly stable. When you look at the track record, why has these 270,000 species flourished? They've flourished because they've been in a stable environment perpetuated by this planet. The foundational anchor of all of those correlated relationships is that planet. What you're doing by looking, if for instance, we say, I want to construct a portfolio of things with strong foundations, I therefore think causally back to things that are very distinct from each other, not directly correlated. So Brent and crude is a bad example, but something like Brent and crypto might be a better example of an uncorrelated relationship. Something like Brent and coffee, Brent and these things that you think, well, okay, how correlated are they logically? You've got to sort of understand in the causal network how disparate they are. And if they are disparate, they are potentially very good, strong foundations for your non-linear growth. So I know it's complex, Jerry. It's just a different way of looking at things. But I honestly think the way economics is going with statistical techniques is the wrong way. I think we've got to go back to basics and look at what real systems are. Look at, not in a statistical way, but in a causal way, cause and effect. Go back to cause and effect. We can rely on cause and effect. Statistics, not so well. And so if we go back and that change our perspective, I think we can see things clearer.
Okay, so, but specifically, I wanted you just to say a couple of words on why you would argue that I am, or maybe you would say that I am, but it's okay, why I'm not necessarily being inconsistent by trading Brent and crude oil, WTI and Brent, but being much more careful as I choose my 150 stocks, that I would not want to trade two stocks that historically were that correlated. But in fact, I will trade two futures markets. What's the best you could say about that?
Jerry, between you and me, we're all inconsistent at times. And I love what you're doing with your stock selection. But we've evolved. You've evolved now into trading stocks. Which are the best stocks? You know that they all have a degree of correlation. So you're worried and you're thinking, how do I know that one is different to the other? And you're using a logical map in your mind to do that. You're less concerned with futures because the futures span across different asset classes. They've all historically tended to work very well, but certain futures are more correlated than other futures. And I think it wouldn't necessarily be a bad thing to revisit the portfolio and look at those correlated relationships, and you might be able to get a better set of uncorrelated relationships reviewing it in this way. I'm not suggesting that, but that's in my mindset. I'm as guilty as you are of this, and I'm learning as I'm going along as well. And it's only because I've been reading these books lately that have sort of taken me down another path. I'm starting to think, oh yeah, maybe I was wrong there. But it all is sort of unifying in a more cohesive story for me, and I'm prepared to follow it. But I'm learning, and I'm prepared to consider looking at how I've been doing things, and in that review, I've found that things could be a bit better there.
Right, and I would just say that two things that I also wrote down as I've been listening is that when you were talking about correlations, and how all the markets are kind of correlated, we also know that the longs are correlated. Everything on our portfolio that's long that has a tendency to be correlated, and the shorts are correlated. And just having longs and shorts lessens our correlation problem and lessens our risk to some degree. And also correlations are lessened with a trend following approach overlaid on top of these markets, as we've said before, and stop losses, getting these markets off our position sheet is important as well. That's one of the advantages of trading. I've said before that in my research, the optimal stop loss, if you just optimize stop losses, it's pretty much equal to the average loss you have from not using stop losses. So I just say, well, heck, then use stop losses. There's nothing to be lost by using them. There's no downside to using a stop loss. Your average loss remains the same, but certainly getting things off your portfolio sometimes lessens the risk as well, as well as we're not subject to the same correlation analysis as the buy and hold people. Morning, Josh.
Morning, Jerry. And fun, Alan Neal's podcast, fantastic. I admire your civility and thoughtfulness and depth that you were able to share about a deeper cut for me about the turtle experience. Really great. And the transition post-turtle. I do want to speak to the potential disparity that you are curious about as you deal with futures and commodities and your curated stock selection. You know, you've got 6,000 stocks. So you've had to decide how you're going to deal with this. And you are taking a kind of market sniper approach to moats, to uniqueness, to idiosyncraticness, to unique, distinct, essentially commodity approach, if you will, to stocks. Big gun, big beauty, big cookie, big Tootsie Roll, etc. So, and it's fun, and you have fun with it. And, you could change your mind, but that's how I see it. You're causing yourself to have from a 6,000 stock universe, what the hell are you going to do, to one that makes sense in a kind of commodity way. Thanks.
Oh, exactly. It's definitely a commodity way. We must force ourselves and our philosophy and what we do onto others because our way is the right way. And then we must force it on the way that we look at equities. I get the impression, even for myself sometime, that my brain has a category for futures and a category for stocks. And my brain on the stock side is polluted by all the bad ideas that are not trend following centric. And it is definitely a way to convert these markets. They're nothing. These stocks are nothing. They are worthless. They're just as worthless as all the futures, except to the degree that I can exploit them with futures markets, with trend following. They're unreliable. They're your friend. They turn their back on you. They crash. They give all that profit back. They're not your friend. They pretend to be your friend. And you need to use them and then put them away until the trend reverses and you go short or something. So, yeah, they are not worthy of our consideration other than for us to. They mean nothing. All the things that people say about stocks, I totally ignore. I'm proud that I don't understand I have no idea what value and growth is. I have never looked into it. I feel like I would be further contaminated if I let those stupid thoughts into my brain. Most of the things I hear about stocks and indices, I have no clue what people are talking about. I want to be dumb. If it doesn't fit, I'm only interested in what fits into my worldview as relates to these markets, and that's with trend following.
A simple question. When you're talking about the P&L or your losses being the same as applying non-stops at all, you're exiting with a signal, right? That's what you're saying.
I didn't understand the first part of your question, but yeah, I'm only.
No. Sorry, you said that what a good stop position is when it's the same as your biggest loss when using no stops at all. That means when you're using no stop at all, that means exiting with the same signal as you enter, right?
No, it means that when I run the system with the breakout entry, breakout exit, and the stop loss, I see that the average loss is a certain number. It's very close to my stop loss. And so then when I take the stop loss off and I use the entry breakout, the exit breakout with no stop loss, the average loss is the same as the first run that included the stop loss.
Okay, thanks. I understood.
I wanted to get back. I have so much more to say, but I got sidetracked on the last answering Josh's question. But I wanted to say something about Amazon because I'm kind of fascinated by success. And obviously Amazon is a success, but Amazon is a stock also that I shorted, that I made a little bit of money on. And I also, there was another article out this week. You remember about Occidental Petroleum, where I was so happy to sell that downside breakout and then read that Buffett was long and buying more. So I lost on that one. Buffett won. I lost. I was totally thrilled that I had an opportunity to ride a big downtrend in that. Did not work out, but still in my fixed universe. That also, I read this article that this week, the stock that billionaires are buying. Yes, I read shit like that. So basically, it was Cliff Asness and a lot of hedge funds are buying the stock that's in a downtrend. CVS, it's a pharmacy here in the U.S., and I'm short that. I'm pretty sure I have a profit in it too. So that's pretty exciting. But the Amazon story that I wanted to say, Richard was going through the chronology of Amazon and starting with books and then expanding and then getting much more profitable as they expanded. Okay, one of the things my experiences with Amazon was another reason that I think they became so successful is because they became, and I think this is by far the biggest key to their success, and that is they're safe and reliable. Because if you remember back in the day, we were trying to buy things online, and that was a big deal. Like, who is safe and reliable? And we were buying things from lots of different sites. But then, as time went on, Amazon was carrying everything. And even if you could find it a bit cheaper on another site, that specific product site, I would still go to Amazon and buy it through Amazon. And it became a situation where it was never even crossing my mind that I should be fearful about buying things online and not talking to someone. And then you become, oh, you don't want to talk to someone. If you're talking to someone, it just means they have poor technology. If you have great technology like Amazon, you do not want to even contemplate the need to actually talk to a human being. I ordered a computer monitor once, an Apple monitor, and it came to my house, and I opened up the box, and it was a microscope, a telescope. And I was like, what the hell, right? And so then I went online, and by the time I had that telescope boxed up to send back to Amazon, I had already received the replacement. And that's how they are. That's why they're kind of amazing. Um, so much to say. I've got so much more to say, but I'm going to let someone else talk. Go ahead.
I think that they are also a great case about being open to outliers, because when they designed their inner systems, Jeff Bezos was really adamant about making them open to everybody, so they could sell them in the future, which is the AWS, and that was an application that didn't exist at the time, but he was open to it, and he forced everybody inside Amazon to have those kind of APIs, they call them, so they could sell between them and between the outer world their IT services. And then that was the part of the business that made them net income positive at the beginning. So that's a great case of being in a corporation, but being open to outlier, which was in the end the cloud, but 10 years earlier.
And another thing is that he talks a lot about trying to create these outliers and take small losses. He doesn't say it's a bad thing to have come up with their attempt at an iPhone or a mobile phone. It's just, hey, we tried, it didn't work, we lost money. This is how we operate. We don't really know which one of our ideas is going to be the amazing one, but we try a bunch of stuff, and then we're ready to risk an amount of money that's reasonable for us to risk.
Yeah, I was just going to add that just back to the discussion of Brent and crude. Over the past 10 years, what the correlation is something like 0.95, I want to say, between the two. I wouldn't sweat the correlation too much, considering, a 60-40 portfolio is 0.97 correlation to the S&P. So I think any edge, any chance for divergence, you should take it. And as you always say, Jerry, it's like just trade as many markets as possible. So, and I don't think stock selection and correlation, interstock correlation, I don't think there's really too much credence to be placed on these structural differences. Actually, I think with the all these ETF wrappers and all the kind of pressures caused by big big institutional shifts, regardless of, the underlying business models and whatnot. I just think there's just such a confluence of, causal factors that, you can't really place your finger on it. You might as well just, throw a dart at a dartboard as far as I'm concerned. But anyway, that's my thought on that topic.
I think once you get going in some of these trends, like I've been long unleaded for a while, heating oil recently, still not long crude or Brent. And then once you get the energy sector going and you get all these markets trending, which we've seen, recently, the Brent, WTI, unleaded gas oil, and heating oil, they all kind of act as multiple systems. So you're trading 4 systems each, but these exits are going to be very critical. You don't want to get out too quickly, but you don't want to get out too late. And so this is where there is a little bit of credence that exits matter more than entries, because the give back can be so much greater and the cost of getting out too quick can be so much greater. So if you put in there all of these energy type markets that are going to be somewhat correlated, the overlay of trend following reduces that correlation dramatically. And you end up having, lots of different exits in this secular energy move because you're trading all the markets and because they're all trading the 4 systems. It's a big, huge benefit. It's amazing because I make the market close above the highest close, okay? But it's shocking how often I get signal during the day on an exit or an entry, then by the end of the day, the close is not above or below. And that was the low, or that was the high, and the market kept going, or I avoided a trade. It's shocking how often, you would just, and so this 95% correlation is somewhat irrelevant to us. And when the markets are doing well, like these energy markets did in 21, I'm looking at the chart now, what do you want your correlation to be? I want it to be 100%. Because they're all going up and making a ton of money. What do you want your short bond positions to be last year? What correlation do you want? 100%. One thing I know what I wanted to say when Josh was talking about stocks, and I lost my train of thought on that crazy diatribe I went through. That is, I have Twitter friends and who are giving me stock ideas. And so not specifically, but I read about, there's some people on Twitter that I follow that are into looking at equities. And they're like, oh, look at this stock today. Look what it's doing. And I'm like, okay, I'm going to go look. And so then I put these stocks on and they're like, hey, good choice on that Goodyear tire. And so, okay, honestly, I have taken some of their advice and I did not have these stocks on my list. That Goodyear tire I did have on my list because it's a smallish rubber company, pretty unique, right? And I have a long list of equities, and I've done a year's worth of research, and it's a lot of reading. It's not good enough just to look at the numbers and the stats, and I would never look at the back test to say, okay, trade these particular stocks. No, it's all about the qualitative, what is behind this particular company and its size and its products. Am I going to get some diversification? Totally biased, totally discretionary, but this is not what we do. It is, once we make these discretionary calls, it's a fixed portfolio for the rest of my life, as long as Goodyear tires still exist. I'm going to follow my rules that are based on some discretion as well, forever as well. So that's how we get around, and that's why the bias idea is not, I know Absolute's chopping at the bit to tell me I'm wrong. And anyways, I have these lists of equities, and I have them all sorted on my quote machine, and I go through the list. Like I have a uranium list, a lithium list, an AI list, a 3D computing list, and just 100 of these different lists, slicing and dicing these sectors with my research. And then I have this one list of stocks that I really love because they're perfect. And that's called the next up list. Here's the next up group. And but I'm maxed out like now. I'm at 150. So I'm like going to stick with what I promised I would do. And unless something gets taken over, which I've got a few takeovers I'm dealing with, I think WWE is going to merge. Yeah. And I have takeovers all the time. So I can add a stock every now and then. So I have to scroll through the charts on this next up list. And I'm telling you, all these big trends that I missed, right? So not only are you having trouble choosing which stocks, I keep a list of ones that I didn't choose or haven't chosen yet. I've been unable to add all these stocks. You can't trade 1,000 of these stocks. And so then it's sad because I'm going, look at that trend. Oh God, look at that next trend. Oh, look at that trend. And obviously I'm getting my fair share, but I do tend to concentrate on the ones that I kind of missed out on. So that's a psychological thing, right? It's so much more comforting. And the CTAs kind of say this. The managed futures guys say this. It's like, where do I start? What do I do? It's almost like these genius people who are great at coming up with systems and overloading these trend following systems with a bunch of crap. When it comes to stocks, they're paralyzed. Well, if the CME would just tell me which 50 to trade, like they tell me which indices to trade, then I would be much happier. And I'm sitting here going, I'm having so much fun with this research project of trying to come up with 150 different ones just to get my fair share of the trends out there. I'm loving this. And it's like, oh God, that's one of the reasons I don't want to trade stocks. I would never know if I was trading the right ones. But I know I'm trading the right currencies because I trade them all. I try to make fun of this all the time. And I don't know if it resonates with anyone but me, but it's the dumbest thing I've ever heard in my life.
Hey, Jerry. Hey, everybody. Yeah, I logged in late today. Again, I'm still wired for the same starting time from before. And I just realized you guys started already 15 minutes ago. So yeah, I probably missed a lot of the discussions. I started with with Rich describing evolution and stuff like that, which was
Hey,
okay.
just know absolute that we're not starting at 7 to throw you off, and we're not going to start at 6 to throw you off again. So I'm joking. It's good. It's always great that you're here.
Okay. Yeah. So yeah, Jerry. So I have a question. I agree with your argument why you trade Brent and crude, and that's exactly the perfect example that you said with the exits and with the entries, where when you overlay a trend following system, even at a 95% correlated markets, you get a much bigger decorrelation because of the slight differences in entries and exits adds to the dispersion of the entries and exits, just like the four systems, which are also correlated. But when you trade them, they give you kind of gradual entry and gradual exit out of the markets, which kind of turns the problem from binary in out into a continuous, more probabilistic problem, not problem, but model of the world. So by trading a group of even highly correlated markets, you're still adding the dispersion and you're adding continuity and you're making the behavior of your system more probabilistic and more continuous and less binary, less depending on a critical in and critical out of the markets. But along the same lines, then this is my question to you. And I think I asked this question before. Because you want to stick and you want to treat all markets equally with the exact same stop loss, exact same risk per market, you limit yourself to 150 stock markets, which is then 50% of your risk out of your total 300 markets. And whereas most trend followers, systematic traders, view equities as just one of the four asset classes and see no specific reason why to allocate 50% of risk to just one asset, one out of the four main asset classes. And the asset classes come again from what Richard was talking about of clusters of correlations. I mean, it's not accidental why we're talking about four asset classes, why commodities, interest rates, equities, and currencies are asset classes, are sectors, because they're clusters of correlation. And without overfitting, without going too complicated with statistics and calculating, it's like if you just assume that there's 4 asset classes on this planet which are clusters of correlation, which you're more likely to find correlation within the asset class than between them. People just say, let's not overcomplicate, let's not overfit, just get 4 asset classes and then just treat them almost equally. And pretty much a lot, if not most, of quantitative or systematic traders see no particular reason to give specific overweight of one asset class over another. But now, because you're so religious about you keeping risk per market fixed, you end up in a conundrum yourself where you do want to add as many stocks as possible. And as you say, there's a lot of them interesting. 1, 2, you do argue that even highly correlated markets are beneficial to add to your system, just like with the Brent and the crude example. So adding 2 highly correlated stocks are also beneficial than trading just one of them that's decorrelated with the other one. So that's another argument why you should trade as many stocks as possible. And the only thing stopping you from trading as many stocks as possible, let's say 1,000, 2,000, I don't know, 1,000 stocks per continent, 3,000 stocks. But you can't trade 3,000 stocks and 150 commodities, futures, because then you will have 99% of your risk in stocks. Then why not just normalize the risk on the 3,000 stocks? Trade your 3,000 stocks, even slightly correlated. You will have much more benefit in terms of distribution of entries and exits with the 4 systems, but normalize the risk per market. Allocate 25 or 30% of your risk to stocks. Within that allocation of 30%, distribute the 3,000 markets and trade them as just one portfolio of 3,000 stocks in your universe. This way, you kill all the flies with one swat. You're trading as many markets as possible. You're diversified as much as possible, and even highly correlated stocks, which now you also agree will be beneficial, you're trading them all. So on one hand, you argue that trading Brent and crude is beneficial because of continuity and probabilistic distribution of entries and exit because of the dispersion. And on the other hand, you don't want to do that with stocks. Why? Because you want to religiously keep risk per market fixed. So my question to you is, why not what I'm proposing?
Well, I've got to think about that a little bit, but now honestly, I never said that I even agreed with that. I was trying to get rich. I was telling Richard it sounds like a contradiction to me. So, and I did say that stuff about the multiple systems only in the sense that this would be somewhat of an argument to minimize the issue, which is, but I don't see any logic, as I've stated, as it relates to trading Brent and crude. You can minimize the problem, but I should have been called out on one of the things that I inserted in that discussion, which is when you have these sector moves. And so, as you know, I talk bad about sector moves, only in the sense that this is what managed futures, how they make their money. It's the sector moves. Now, I appreciate the sector moves. And that's the reason they make money in the sector moves is, and our goal is to make money in these big, huge outliers, individual outliers. So maybe the short-term interest rates were a big outlier, possibly, and but the managed futures CTAs scaled those back because the vol incredibly increased to turn them more into looking like the 30-year bond. And so because they don't like these outliers getting out of control and having high vol and dominating the portfolio, and like Richard and I do, so they want to turn everything into this lookalike and rely upon the sector moves. And so when I started talking about the energy sector moves, the comeback could have been, wait a second, you're trading heating oil and Brent and crude because one of them can have a big, huge outlier at the same time the other ones don't. True, because that's our hunting outlier. But that's where we appreciate the sector moves. We like them, and we are appreciative of them. But the reason we trade everything the same size is because we're hunting for that outlier, and we're putting that front and center and on top of everything else. And not and the quants don't understand the CTA trend following, and we don't look at the world the way they do in this four asset class thing. And we're hunting the outliers and not trying to balance anything out necessarily. I have accidental diversification. If I'm really smooth and having a smooth return and not having a lot of volatility due to trading so many markets that are similar to each other, it's totally by accident because I've sold out totally to, okay, I'll trade 300 markets. I'll have this diversification, but I don't really give a damn about it because if something gets crazy and starts dominating my portfolio, these outliers, then I'm going to go with it and not ever cut it back and not ever try to correlation manage it or volatility manage it. And these stocks have a legitimate 50% of the portfolio for one reason and one reason only. And I've said this many times. I say the same thing over and over, and that is because they deserve it. They deserve it to the degree that they add diversification. And inadvertently, the way we're handling this is that if you have a certain sector that has more markets in it, it is going to be traded higher. So in the meats, there's three markets that I trade, and they're all traded the same size. And then in another commodity sector, like energy or the grains, I'm trading many more, only because there's more diversification there. What is it? Have you measured that diversification? No, I don't care. You could say that the three meats are less correlated than the 10 grain markets. Fine, go ahead and say that. Not you in particular, absolute. But someone could say that. And I would say, yeah, I'm down with that. I don't really care if that's the case or not. But to get these unique outliers that can come, and we definitely had outliers during the grain markets in canola and rapeseed and maybe some others I can't remember. But that's why we do it. We totally reject this idea of four asset classes. They don't exist in my mind. Equal weighting them, of course, that doesn't exist either. But you bring up a really good idea, even though it does kind of counter the reason I've just given to trade each one of these stocks. I'm going to trade them the same size, but your idea was a bit different, and I have to think about that to a degree. I don't think I would go for that, but I will say another thing too is I feel like the reason I don't trade more equities because I think probably stopping at 50% is arbitrary. And if I'm going to say that I can come up with another 150 that are going to be just as uncorrelated as the 150 I have on now, then why don't I do that and trade those with the same unit size? And I guess it's due to peer pressure or some sort of non-systematic mathematical reason that I don't, because I'm historically in love with the commodities and the currencies and the interest rate futures, that I can't bear to see them be less than 50%. So none of that sounds very scientific. And I think that's the reason I don't do that. But I could see myself changing my mind. And then, of course, I've said recently that there's more diversification to be gained from the stocks than it is the other three sectors, only because there's more. You have to do the work. If it's not the case for you, if you don't have longs and shorts on, you're just not doing the work. You're corrupted with trading tech stocks or looking at the stock market in the way that other people look at it. I look at the stock market the same way I look at the commodity market. I'm going to go out and find as much diversification as possible, trade them all the same size, and trade as many as it makes sense to trade based upon the diversification benefits and the lack of correlation benefits. So I think, okay, so final point is one of the things that's going to happen to me one of these days is I'm going to lose a lot of money. I'm going to have a bigger drawdown than everyone else because I have on so many equities, and they're going to be highly correlated. More than likely, I'm going to be long everything during after a big, huge bull run, and I'm going to have made more money than everyone because I was overloaded in equities. Then I'm going to have a bigger drawdown than everyone because I was overloaded in equities. All I can say is the same thing can happen in currencies and commodities and interest rates. I was 100% short interest rates last year, pretty much still am. I was 100% long dollar a few years ago. And now I have more longs and shorts on. And now I have more diversification in the equities than any of the other sectors. I usually probably will, it will probably usually be the case on a day-to-day basis. But one of these days, I will have on almost a huge allocation to equities because they're all in a uptrend, making tons of money, and I'll come in one day, not have enough shorts, and everything will be correlated, and I'll get my ass kicked. But that's the nature of the game. We trade all these markets. We're looking for diversification. Sometimes they're uncorrelated. Sometimes they're not. We look at all the data. The data tells us what to do. And then all of a sudden we come in, and it's one of those periods that the data, it's in the back test as well, that, oops, yep, it's 2000 something, and you're going to get your ass kicked because the stocks are going to go down a lot, and they're going to go down before you start getting meaningful short signals. Sorry for the long one.
No, I totally hear you on that, Jerry. I kind of always thought that delineating between asset classes within the context of the CTA, typical CTA, quadrant, 25% each type AQR style. It always seemed so absurd to me. A market's a market, and equities, these expansions and contractions in price multiples are so often just the meme stocks, for example, but maybe a less severe example of that. People just sort of start acting mimetically, especially in a market that's watched as closely as the equity market is, with people staring at their cell phones, Yahoo Finance or whatever. But so I think it's just as good a place as any to kind of overweight. And just one other example of the lack of structural decoupling that actually manifests itself is I was just looking at Pepsi and Coke over these monthly correlations, and the past 15 years it's 0.19 Coke to Pepsi. So that's like the example that I always used to use for tax loss harvesting, but I guess I was being an idiot when I was talking to clients. Anyway, it's I also think the sort of just picking an arbitrary thing like half the portfolio, you got to have a loose hand on the tiller and not over optimize when you're dealing with complexity. Otherwise, if you really try to overfit, you're not going to harness it. So I think it's a beautiful approach.
Hi, Jerry. So I did not understand the explanation to my question. So when you say that you answer that the other CTAs are doing vol management and trying to not hunt outliers, then because and you don't want to do that and you're looking for outliers, I don't see how that answers my question. Why is it better for you to hunt outliers on 150 stocks versus 3,000 stocks? To me, you don't have to vol manage. Hunt outliers on 3,000 stocks. Just allocate less risk per stock because there's 3,000 of them. It's not 150. And there still will be outliers. There will be proportionally more outliers in 3,000 stocks than in 150, and you will catch more of them. When you trade 150 stocks, you're not catching the outliers from the rest of the 3,000 stocks. So, and in order to do this, you just have to normalize the risk you're putting per market. That's all. You don't have to vol manage, just hunt for the outliers. And I'm really, really surprised how comfortable everybody here is to just neglect sector exposure as if it's something in otherworldly or illogical, or it's curve fit. Dividing markets into sectors, it's not curve fitting. It's experience, and it's logical. It's logical that as the cluster of commodities will be less correlated with the cluster of stocks, which will be less correlated with cluster of bonds, which will be less correlated with the cluster of forex, because by nature they're different instruments addressing different segments of the global markets. And then to just go blindly and say, you know what, I'm a trend follower, I'm going to risk exact same risk per market, and I'm just going to trade whatever markets are on offer, equally treated, and I don't care what allocation of risk I have per markets. So if there's 10 commodities, I'll just trade 10 commodities. If there's 500 currencies, I'll trade 500 currencies. So I'm going to have 50-to-1 risk exposure in currencies versus commodities. Or if there's 10,000 stocks, I'm going to trade 10,000 stocks. So I'm going to have 100x more risk into equities versus commodities or forex, because just there's more stocks to trade. To me, this makes no sense whatsoever. Why not normalize per sector?
But nobody's doing that, and I think
no. But your argument is that you're trading all the markets in commodities that are there, and it just so happens that the numbers of markets in commodities, currencies, and interest rates, whatever, just so happens that they're closely matched. So there's not you're not end up trading 80% of your risk into forex versus commodities. Because
that's exactly what it is. It's exactly just.
But you can create cross pairs. You can create cross pairs in forex to make the exposure to currencies to be 10 times more than your exposure to commodities. Why don't you do that?
Right, because I think I don't want to acknowledge that I'm looking at it this particular way, but I am essentially making this choice, and then I'm saying to myself, just the way you describe it, I'm essentially making that choice and saying, thank you, futures markets, for doing this for me, giving me somewhat of not a crazy exposure to commodities over currencies or over interest rates, but it's all kind of balanced in a way. And then I did have to make that choice to not go crazy with the currency crosses. And so then I say to myself, okay, unscientifically, I don't want to go too much over 50%. So I'm in fact having that in my brain that's limiting me from trading all these equities and stopping it at 150. And other people may say, well, that's way too much for me. And then I would say, yeah, I'm not going to go any more than 150. I'm admitting that these are discretionary calls, that it makes me nervous to go more than 150. I have traded 25 or 30% of the portfolio in equities and had really bad experience when stocks reversed. But I have my short exposure better situated now, and I didn't have my system wasn't able to put on enough shorts when I should have the shorts on, and stocks were trending lower. So now I've got that much better taken care of, to where I'm usually going to be long some and short some, and I could just be overwhelmingly short, obviously in a 2008 scenario. But so we're kind of embracing and acknowledging this kind of like, and you're calling me out, and that's fine, but I'm kind of doing that and limiting myself and acknowledging in some ways of this, the dangers of not paying attention to sector. Although we've seen many times where every market was up and every market was down, regardless of sector, and that's definitely COVID. So the initial choice of leverage and your unit sizes is critically important, because everything can go against you. We've seen that happen, and there is no diversification. So I guess all I'm saying is, at the same time, I kind of want to trade all of these markets with the same, after I've got my portfolio squared away and I feel comfortable and I've got a lot of diversification, and it's okay to trade 50% equities, single stocks, long and short, then I'm going to forget that. And then I'm going to be very strict and lecture you about how I don't want to pay attention to these sectors anymore. I'm going to trade a consistent unit size on every single market. I'm only hunting outliers, and because I've already taken care of this other stuff. And so you're right. It's not really consistently argued on my part, but no one is doing what these extreme examples you're laying out. Now, I think I did answer your question because it was instead of trading every stock the same, fixing it at 50% of the portfolio and trading every stock and every other market the same unit size, why not trade thousands of stocks and just lower the unit size to keep it at 50% or whatever percent it is? And as I said, I've not thought about that. I think that that does violate this idea that we're mainly hunting outliers, and the outlier can come from anywhere, and trading everything the same unit size acknowledges that. And I went on to say, probably in my mind, maybe more logically than your solution to trade 3,000 stocks with reduced unit size, I feel like maybe even more logically, I should just trade 3,000 stocks, same unit size, to where commodities and interest rates and currencies become almost zero weighted. But I can't do that because of my history of loving those markets, and they do offer diversification, and they are different. And as you said, just it is beneficial to pay attention to the asset classes in some sort of way that I pay attention to them.
Absolutely. Have you looked or seen any data? I mean, does that still hold true that I'm not challenging you. I'm just asking it. Have you seen that to be the case that over the past 5-10 years there hasn't been a degradation in kind of cross asset decorrelation, so to speak, as opposed to or relative to the equity market? Because as I look at something like Romo, which is this newfound and resolve joint ETF, and then I'll look at Andrew Beer's fund, which is essentially classic trend following, but doing a regression. I understand it's not actually classic, but then it's hard to find something that's strictly commodities. So, but any commodity fund that I put in, it's just got massive standard deviation, even though it's got tons of different commodities in there. Yeah, even the ones that I look at that are equal weighted. So I'm just interested in whether that's an actual fact or not. And I'd also say that we don't know what the future holds. So it could be that stocks are the source of diversification. I don't really. There's a lot of prognostication about back testing, but I think we know that trend following generally works.
Yeah, I mean, I've done a lot of analysis and a lot of testing on this thing, on clustering, on correlation clusters, on different time frames, different lookbacks. There's a lot of math here that you can use. So, yeah, I mean, there's a lot of edge in this answer. So this is not trivial. Like, what I know and what I can say is that it's very difficult to extract statistically significant benefit from correlation clustering that goes beyond sector clustering. And if I can, or in other words, you can do a lot of math, and Jerry says correlation management and whatever they call that. You can get very fancy, but the optimization between overfitting, consistency, and robustness. So basically, first you have to have a big benefit over just using sectors as clusters for it to overpower the risk of overfitting and additional complexity. And there are some systems that come close, but the risk is very big, in my view. because I'm also very concerned about overfitting and stuff like that. So my conclusion has been, over long periods of time, over 50, 60, 100 years, or in tests and whatever, markets change, correlations change. The most stable over the long run, midterm, and whatever. Things may fluctuate. Things may get correlated. Stocks may get correlated with bonds, inversely correlated with bonds. Commodities may get correlated with bonds when there's inflation or when there's deflation. So over short or mid periods of time, you can get correlation, and the optimal clusterings may change. However, those things don't last, and they're different, and they're shifting, and they're dynamic. The only thing that's relatively stable in terms of correlation clustering are sectors. And that's why if you want to keep your diversification optimal, you should keep exposure to sectors relatively closely equal to one another, not overdo it. I personally would never put 50% of my risk allocation to equities. I don't care what Jerry says, that they're diversified, they're whatever. I don't know, 150 longs, 150 shorts. And for some reason, he seems to have picked stocks that he only shorts, and then he hopes that he will have enough shorts when the markets rallies, and then the drawdown's not going to be big because he's going to have some shorts. I'm not very convinced. I don't know. That may happen. And it's with hand-picked 150 stocks that he hasn't backtested. So it's really like a logical kind of a, I think that's what's going to happen. I'm not sure, but I think it's going to be much better. I'm comfortable with half of my risk, all my strategy. So basically what he's saying, he's trading his strategy, one version of his strategy with commodities, currencies, and interest rates, one version, and another version, and the same strategy with the same size with stocks. And instead of trading the strategy, trading 4 instances of the strategy with equal capital allocation. Let's say you have 100 million fund, and you allocate 25 million to commodities, 25 million to interest rates, 25 million to currencies, 25 million to stocks. And you trade 25 million in the sector, and you trade them however you want. The 25 million allocated to equities, you can trade 3,000 stocks there, but it's 25 million size. The 25 million allocated to commodities, there may be 30 commodities, but there may be only 10 commodities, or there may be 70 commodities. Why should you care? Why should you depend on some random market situation or a snapshot of how many markets are there per sector, and for that to drive your risk allocation to that sector? For me, to allow the number of markets in a sector to drive my allocation to that sector is very random. It's not scientific. It's based on nothing. I'd much rather control.
I think that's what typically managed future CTAs do.
Well, that's their problem.
Oh yeah, okay, yeah, it's their problem. And then you start off by saying this thing that none of us agree with, and then build your argument on that. And so you started out by saying, if I'm interested in this optimize, well, we're not. We're not interested in optimizing the portfolio for diversification.
But you are interested. That's why you don't have 99% of risk allocation to equities.
There is a limit. Exactly. I'm not going to go over the 50% limit. These stocks.
What's so special about 50 versus 30 or 25?
There's nothing special. It's, as I said, it's this discretionary, random, emotional choice. You're not happy with it being 50, and now you're arguing, why isn't it 70? Well, okay, I can agree with you. We don't agree that it should be 50. We both do agree that it should be higher than that. So that's, and to the degree that you get this diversification and you choose equities that have this diversification that are much different, and you can have a reasonable number of shorts on, it's a new ball game. And that you put in markets in your portfolio to the degree that they add diversification. So, and as I said, you can do it in a much better way, in a much more perfect way, the way that you're describing, or the way that you do it. And there have been times where regardless of how you do it, everything's going to be correlated. We saw that, and so you have these exceptions where it's going to occur, but looking at these sectors and putting your rules, having this emotional response because it's in a sector approach, because there are four sectors and you're trading some sectors larger than others. This is just not part of a trend following mentality that is going to be so focused on that and so precise on that idea, but it is going to sort of respect it in some sort of approximate way.
Hello, Jerry. Hi, guys. Can you hear me well? Right. All right.
Yes.
So just a few thoughts on the discussion today. I find it fascinating, by the way. It has been great discussion. Now, between the 50% stocks or 25% stocks, equities, for me, it is a discussion about, if I take a step back and keep my objectivity, it's a discussion about robustness versus adaptability. And, there's a science, but also there is a art into what we're doing here, at least what I'm doing in my work. And so that's, for me, it is that robustness versus adaptability. So 25% into each sector, including equities, would work usually, but it wouldn't work during the managed futures winter. So, so the question is, this is what is called capital allocation. And would you allocate your capital into these asset classes like forever? Right? Would you do that? Would you be trading the same allocation today in 1926, 1930s, 1940s? Or at some point in history, would you like to change it a bit? I think that's more of a, as Jerry said, it's more of an emotional, and for me, it is it's a personal choice. I'm a trader. This is my art as well as science, and I might give a different value to adaptability, to robustness. Okay, it's going to be robust anyhow. So 25% is going to make money all the time, but 50% is going to make money also during managed futures winter. So I think there is value in both arguments. So that's one thing to talk about. The second thing is, the Florin Court is talking about a MAR ratio of 2.0 as opposed to 0.5 or 0.6. So there is really a breakthrough idea there. I think it's worth taking that idea seriously and see how, whether it is genuine, just to explore that. So the third thing is that I would like to talk about a key belief. For me, the brain is very fascinating subject, and these beliefs are part of our belief, our brain. And one of the key beliefs that I do have is that I'm in the data business. I'm in the data business as opposed to as anything else. So I would rather have all the data that I could put my hands on, especially if one day I could trade 7 digits as opposed to 6 digits, then it's going to give me more leeway in terms of buying more data. And even though I'm not trading like these swaps and CDSs and mortgage-based bonds and tips and Chinese commodities, I'm sure the data is not that expensive to test whether the results are coming better or not. So I'm much more on the action side rather than just to talk about it. I would rather buy the data and see what comes up with it. It is really going anything else beyond existing MAR ratio. Is there any value, as Florin Court says, that is approaching to us? Because I find that argument really fascinating. The other thing is, 1970s. If you go back to 1970s, there is a grain market, or whatever the future markets are doing much better. I agree with Jerry's argument. Of course, each market has the same expectation over time, but I wonder when the market comes up first, is it possible to dip into that equal expectation a little bit more in the early days of the market and a little less during the later days of the market. It is the same expectation all the time. A market has the same expectation, but this doesn't mean that that market has the same expectation all the time. So that's that. Also, I'm definitely in the camp of trading the entire Russell 2000. Cole Wilcox has tweeted that at some point. I really love to trade all the 2000 and let the market cancel me out, stop me out, and only the best stocks remain at the top. That sounds beautiful to my mind, but it will be operationally expensive. So maybe this is not a business thing, and that's why I understand Jerry is way more practical than I am. But for me, if I take a step back, I find that trading 2000 is an excellent number, really. Also, Richard has mentioned something else that caught my eye. He said that correlation versus causality. Well, and he said that there is a correlation between Tesla and potato chips, but I am not sure whether there is causality. Okay, that's a fascinating argument, But do we care about causality? When the markets and the world take the pear shape, do we care about causality, or do we care about the fact that these are going to move at the same time? So it's just a question, because it's a really, really good argument that Richard has made, correlation versus causality. I've never heard that argument before, to be honest. But the question is, do we care about causality? Do we ever, or do we only care about the fact that the prices move at the same direction when the world takes pear shape? So that's a question to think about. In terms of, I'm in the camp of looking into the markets on a trade by trade basis. So, as long as I'm able to catch outliers, I really don't care about, equal sector allocation or not. There's a lot of adaptability there, as long as you're able to catch the main meats, like the bonds have moved in 2022, equities were great on 2021. Something else has moved during the COVID in 2020. So as long as you're able to catch the main items, I'm not really too fussed about the exact percentage. But as I mentioned, there is a personal decision to be made. Always adaptability versus robustness there. And okay, and the final point that I would like to mention is, we usually talk about these outliers, like three outliers, three times. What is the definition of an outlier? It's something else that we make 3 times to 100 times of the risk. But I really don't like putting a top end. So I'm perfectly fine with the 3 times the risk on the lower end. But as an higher end, there's no higher end to these things. Like now I'm trading single name stocks. And one of the stocks that I traded just jumped from 10 to 30 for instance. It's in my fixed portfolio. So it's like 50 times the risk. When it comes to at the end of the bull market, I don't know, maybe it's going to hit the stop because it's very volatile, or maybe it's going to go to the 200 times risk. So there is really the equities has huge outlier potentials in terms of the risk return, and I think it's very important not to put any emphasis on what these outliers could return in terms of the risk multiplier, because why not 1,000 times our multiplier? Why do we need to define something else? And I think that's the best thing about our approach. It could be anything else. And in my work, there is nothing more potential than the single name equities that can make the more multiples of the our multiples. So I'm just like fascinated about what is happening in the bull market at the moment. A lot of stocks are just hitting to stops, jumping down over my stops and whatnot. So I'm risking very small, like 20 basis points. But when I catch an outlier, oh hell yeah, I mean, this could, one trade could be the year of the trade. A single trade can make my year if things go well. Thank you.
I definitely don't want to limit myself to being sort of CTA managed futures. I definitely want to get out of managed futures. That is a box that we should escape from. And so I'm really just trying to put together what something that is more of a better portfolio. And it's odd to argue about how many stocks you have. In this space, it makes perfect sense. And to me, it would make perfect sense. But for the rest of the world, they'd probably say, well, I love your portfolio, but can you get rid of those other markets that are not stocks? So this is the world we kind of live in. And I think and this is what people kind of want is when what they need. There was a great quote from Eric the other day. I'm trying to convince people to want what they need. And I think this is what they need is they need to have a lot of their stocks with trend following, with a trailing stop and a stop loss, and a better portfolio and more diversification and some shorts all the time, if at all possible. And and they would not resonate my argument about, well, actually having 50% stocks because there's so many and they're so different that even looking at it from my point of view and not a stock-centric point of view, I can justify intellectually having 50% stocks, maybe a few less, maybe a few more. And then I'm going to be more correlated to the stock market and not provide crisis alpha, which I don't want to provide. I'm doing more for crisis alpha than anyone because I'm trading so many stocks. I'm going to the root of the problem. I want to prevent this crisis. Come in long, 100% long, buy and hold with no stop, no trailing stop, no stop loss, and no shorts. Now allocate 5 or 10% to CTAs. Yeah, it's going to suck. So trying to do something a bit different. And as I was on this, I did a podcast yesterday, and I was going off more unhinged than I usually am. Although the host of the podcast, when I said that, he said, "Oh no, I've listened to your past few podcasts, and you don't sound any crazier than you today than you did on those two." And I'm like, "Oh, okay." But I'm kind of going off on this stuff. I really, at some point, would like to talk about this new thing called return stacking. Well, it's a new phrase, and I was going off on return stacking and why people are doing this and ascribing some bad motive. And I said, look, at the end of the day, though, people are doing things to raise money. They have to make a living. And if you need to come up with some silly phrase like return stacking and do some trend and do some stuff and then create a product that is long bonds all the time or a little bit long stocks all the time and do your futures trading on the side and call it return stacking. Okay. I mean, the guy's just trying to make money. He's just trying to have a business like me. And even me, I said, hey, look, don't even listen to all I say because whether I even know it or not, I'm doing the same thing. I've come up with this perfect portfolio idea. And a lot of it does have to do with the fact that it's an ETF. We wanted it to be successful. It is no one is doing this. Why not do something that no one's doing and a little excess with a lot of different stocks? And it happens to be trend following. It's not managed futures. I don't want to be a managed futures person. I love the word CTA. I definitely want to be a trend follower. And I'm just trying to make trend following better and not using vol management, correlation management, and just using loose pants and breakout entries and exits. It immediately puts me in, at least in the top 5. And now I'm adding all these different markets and all these different stocks. And and so I think it's absolutely wonderful. And so that's, that's the reason we're doing it. And I'm not, I want to be unconventional and not fit in. And I don't think it's anything in the world. Most of this world would say I'm not trading enough stocks. So, okay. Does anybody want, it's already been 2 hours. So does anybody want to follow up the next few minutes?
Yeah, And you're just having more fun, I think. And that's quantifiable.
I mean, yeah. I mean, it's interesting. It's interesting to find all these companies, and a lot of my stocks too are commodity based. You know, I was sitting at the dinner table one night, and I was like, "Oh, are there any companies that mine salt?" And I was like, so I got on my computer and I started finding a couple of companies that mine salt. And so sometimes I get information from Twitter, or I get inspiration from Barron's or Bloomberg, and sometimes just from people. Like I said, my best stock this year is in a big, huge uptrend. And I guess they had earnings or something the other day, and it had a big pop higher as ELF. You never know where these trends are going to come from. And honestly,
Jerry, don't forget that the biggest outlier probably this planet's ever experienced is the spice trade with the Dutch East India Company. That was many times bigger than our biggest companies today.
right. Bitcoin, the first Bitcoin trade was, thousands of ATRs. Well, I do want to also, another topic I want to get into is later in another podcast is, I came up with, I think it's time for me to bite the bullet and quit pussyfooting around with this next topic. And I broached it on Twitter, and I think that I just need to embrace it. I'm not going to say we, because I'm not going to require anybody to come along with me. And and that is drawdowns of your total equity drawdowns don't matter. They're irrelevant. They have nothing to do with risk control and capital preservation. And they should. Not only is Sharp bankrupt and worthless, so is drawdown of peak equity. However, you can't really talk about proper trend following, risk control, and money management without this one topic that gets no love at all or mention at all, and that's trade level calculation. And that's the reason it's true, is because of our trade level calculation, which is using capital and preserving that capital and taking small losses in relationship to the size of that capital. We could care less. We have nothing to fear from drawdowns on open trades, where all the vast majority of the drawdown is going to come from. It's only the drawdown in that capital account, which historically is zero when you add in the open trade equity on any single day in history. So I think that's a topic for the future, as we don't have much time left today. But I do think it's time for, at least for me, to quit dodging that and just be totally crazy. And that's the truth, because that is the truth. And it's not polite, but we've already demonstrated where Sharp is irrelevant. Sharp is not irrelevant. The other Bruno a year ago or whatever said that the key to Sharp being irrelevant was our trade level calculation. But if you don't use that type of trade level calculation and you use current AUM, yes, Sharp, you are beholden to Sharp, and you do have an issue. But if you don't, then you're a free person and you're focusing on capital and risk of ruin and staying in the game. If you do it this particular way, you can trade larger, make more money, and just try to convince people that the drawdown doesn't matter, which you're going to have no success doing. I mean, come on. You got to have a safe space in this world where you can have it both ways. You can say what's right and know that no one is going to believe it and act on it. And, that's why the AUM for a classic trend follower is somewhat limited, I suppose. Okay, one more chance. Does anybody want to say anything before we leave?
Hey, Jerry. This is Pete Carmesino. How are you? I've been wanting to ask you this question for a while. Just had an opportunity, so sorry that I'm making this call a little longer. But congrats on the ETF. And I just have a question that's kind of twofold, and then I have a follow-up question. But The first one is, how do you adjust the objection? And I'm assuming you've back tested, but you've obviously been doing this since '94 or so, or maybe even earlier, the current strategy. So you've got your track record, but for those who don't, how do you overcome the objection of back testing a strategy and then trying to implement it? And on the back heels of that question, is there any software other than Excel that can help someone test their strategies in a more robust manner?
I think there are some software. We have built our own software through MATLAB and Python. There's something called Blocks, BLOX or BLOXX. I'm not sure.
Trading blocks.
Trading blocks, yeah. Yeah, that's probably a pretty good idea. But people here in this space other people have more experience with more off-the-shelf type of products like that. But Excel is fine too. We've definitely used Excel. I have two people that work for me, and because of technology limitations, and when we started in 1988, Excel or Lotus 123 was the only thing possible. But two guys on my staff, they have written some of the greatest Excel programs of all time. So it's doable, but I think it's difficult to overcome people's perceptions of the back test. But it's more important to be honest and come up with your own skepticism of these back tests, which I'm famous for saying. I try to take as little from the back test as possible. I don't see I'll never move off of this. There's no reason to backtest new markets that you're adding or stocks that you're adding. Thankfully, some of my stocks there are very recent companies, and some of the stocks that I've added, I was noticing this the other day. There are very old companies. They're from the 1900s, and the reason is they're commodity based, and a lot of these there's a handful of commodity based companies out there in the Midwest of the U.S. that have been doing the same thing for ages, and they're not that large, and they're just making things and using materials and creating materials, producing materials, and so the cocoa contract has probably been around as long as some of these companies. So I think that, or soybeans. So I think that's not surprising. But so I think you want to take as little from, and I like to take the trade stats, the average trade, the average win, the average loss, the average trade profit, the winning percentage, and things like that, and just try to build a system, because that's what you're trying to do, is build a system that is going to work well in the future. And then the equity curve can be all over the place. If I was to look at the equity curve, which I do, I would assume it's going to be way worse in the future. But I would sort of want to just put all my hope on these trade stats and realize that you're building up these trade stats. You're using all the data. You're not using recent data. And the ultimate issue for me is, because I'm using all this data and have all these different markets, the addition of a new market, a new stock, is not going to move the dial as it relates to changing my strategy. It's just 1 out of 300. So how could it possibly be relevant? Some markets you add, the history is going to be different, but they're all converging on the same average return over time and having the same expectation over time. And so I think it's just be very comfortable yourself with your back test and the system that you have. And I think it's more rock solid to come up with these systems that have juicy average trades and good win rates, 40% win rate, and go into battle like that with lots of diversification and not relying too much on this historical equity curve. And if you do rely upon it or look at it, just assume it's going to be a lot worse in the future.
Okay, appreciate that. Thanks.
By the way, Richard, evolution is not real. I can send you links. Evolution doesn't work. It works for small adjustments between organisms and species, but it cannot answer for the origin of species or origin of life.
No, I agree with that.
Mike and I had a good podcast. Another topic I told him I wanted to get on. I guess we're going to do another podcast today. We're going to record one, but Mike is on, we had this our latest podcast. I think. Oh yeah, we wanted to talk about one of the things with Niels and Alan was I was being asked too many questions, too many different subjects. For someone who could go on for an hour on one subject, I felt like when I was done, like, did I say everything about that subject? I think I left something out. And so with Mike, I was like, hey, let's just get on to one subject and let's just try to beat the hell out of it. And so we got on to why we trade single stocks. And I felt like I didn't leave anything out and felt like we did a really good job on trading single stocks. There's no legitimate reason not to trade single stocks. I mean, I've said it 1,000 times. No CTA would trade the dollar index only or a bunch of dollar indexes. No. Commodity index. No. Okay. So it's this crazy thing about managed futures, preserving your business, fitting in with what these clients say that they want, at the same time torpedoing your own business. Okay. So then we got finished talking about these stocks, and how great they were. Even if you do 10 or 20% of your portfolio, that's fine, but just get away from indices. Okay, but we didn't talk about how much we hated indices. And I was like, oh crap, we got to have another podcast for that. It's not the same thing. We got to talk about destroying these indices. They're so horrible. They're so bad. No one should trade them. And from a trend following perspective is particular, or maybe even systematic. But yeah, if you're the buy and hold thing is so wrong, but at least they're doing that. I've heard people talk about religions. Like I really like this one guy. I can't think of his name, but he was really on TV a lot talking bad about religion and God. And then people would bring up examples of where people were trying to soften some of the rigidity and rules in a particular religion. And he would say, oh no, I respect the real kooks who stick with the specific religion and all of its rules much more than these people who come along and want to take things out and add things in to make it more palatable to the rest of us. And so buy and hold is so dumb that, but I do respect them that they do it, right? I respect that. And if you want to take that approach, and that's all you can do, or you have this specific idea of wanting to exposure in the stock market for some reason, like you have inside information, the stocks are going to rally like crazy, then buy an index option, I guess, or buy an index. But it makes no intellectual sense to trade these indices. They're indefensible. And like most of the things I rail about, no one ever is able to say too much against it, because if they do, I agree with them. If they call me out and they get me, I will immediately say, oh crap, yeah, you're right, I was wrong. But yeah, there's no reason to ever trade these indices. So that's another topic I think maybe Mike and I will get onto, and Oleg can summarize it and tell everyone how wonderful everything I says is, which I really appreciate that.
Wait, what is your criticism against trading indices?
Well, trading them from a trend following point of view or systematic point of view,
yes,
is that you can't close your eyes to the fact. It's dishonest, intellectually dishonest, to close your eyes to the fact that it's an amalgamation of a bunch of markets that you can deconstruct and trade all 500, long, short, flat, size them the way that you want to with your ATR approach, and not be told that it should be cap weighted. And you get more profit, more risk reduction, and not even. And there's probably something to be said, which I don't really care too much about, which is they keep changing the constituents all the time, and you're continuing to trade that stupid thing as if that had not occurred. And so, intellectually, from a systematic trend following point of view, it's so inferior, and obviously you don't get the outlier trade and you don't get the 500 ATR profit that we had in Tesla because sizing that particular Tesla position at the breakout based upon its ATR is a big part of it, So, yeah, that.
But do you find that in your, let's say if you trade your strategy with the indices, do you find that the, let's say 3-to-1
Jerry,
win
just a
to
quick
loss
question.
is
Is this your
different?
biggest ATR win, the 500 ATR? Is this the biggest ever? Thanks.
Go ahead, absolutely.
Yeah. So do you find if you run your strategy on a set of indices, do you find that the same statistics doesn't happen, like the 3-to-1, the 40% wins, and the 3 win to loss ratio? It doesn't happen there?
Well, you definitely don't get the outliers on the upside, and there is a material improvement on the drawdowns as well. You can see it here now that all the indices are long, and it's easily possible to find longs and shorts using a trend following methodology if you look at a lot of the stocks. I think that if you limited yourself to the constituents that made up the index, it would not be as different as if you tried to do something better, a better approach like smaller companies and companies that have less diversifying qualities, like a conglomerate, a multi-billion-dollar company, $100 billion company with 50 business lines. I think that, but yeah, I think it doesn't really matter either. I think intellectually, I can't defend being long the S&P when a material amount of those stocks are in definable downtrends. I just couldn't do it. I mean, I can't do it. It's just as good, or it's not that bad, whatever. But I'm just not going to kid myself. And I don't do it in my other life. I don't do it in my futures. I would never consider it in my futures, my currencies, commodities, and interest rates.
But there's an argument to be made. I mean, this is what I've noticed with my testing, and I've tested individual stocks, I've tested indices, and there is a argument to be made that the index, which is a set of stocks, it's less exposed to noise. There's more signal in it than noise, because the noise of individual stocks cancels itself out, and there's more of a macro signal left if you do want to be exposed to a macro signal for a certain country or a certain market. So yeah, I understand if you're trading Tootsie Rolls, most of the volatility and the movement will be caused by supply and demand of people wanting to suck Tootsie Rolls or not, or whatever, and much less exposure to a macro signal as to how much fiat is being printed, where interest rates are going to be, and what's going to happen. So these are two different things. So if anything, I'm not against trading individual stocks, but I think individual stocks, especially as specific and idiosyncratic as you want them to be because of the diversification, you are trading two different things. And I think, why should that prevent you to trade also S&P 500, which exposes you to something different, which those 150 stocks either don't expose you or expose you in a much noisier way? There's much more noise in a single stock to the macro signal versus the noise to the macro signal in an index, because Tootsie Rolls will be canceled with soybean producer or maker or whatever. Like, the idiosyncratic noise will get canceled, but the macro signal will remain in the set. And I used to call myself systematic macro. So if I want to be exposed to macro factors, like things that are on a macro level, central bank related, interest rate related, the best avenue for you to express an opinion would be an index, because, as I said, a lot of the stock idiosyncratic factors and signals cancel themselves out, and the macro signal to noise is maximized in the index.
Right, I can't do it, but I've thought about that. I've thought about doing the indexes as well. And part of it, I think, is just my brand not wanting to do that. And I really just don't see me doing that. And I'd rather, it's a CTA trend following thing. And it's another thing, too, I don't want to acknowledge and put into my philosophy, which is stocks are different. Yeah, I'm going to be the last holdout on that.
But don't most CTS trade futures index futures?
They do, right?
Yeah,
that's what I'm saying. Why do they do that? They shouldn't do that. Why am I the only one? It doesn't make any sense. They should love the individual stocks like they love their individual currencies.
But why not love both? You can love both.
Then you throw at me. Then they too would throw at me. Oh, stocks are different. The whole world says that the stocks are different.
Okay.
I don't think they're different. I don't treat them different. Cocoa's different. Crude's different. We trade all the markets the same. We argue for doing that. Currencies, commodities, interest rates. We argue that you're not supposed to segregate the longs and shorts and change your system or your weightings from more longs than shorts. You add up to get the sample size, you add up all these markets, the longs and the shorts, you trade them the same way, and you close your eyes, and then you say, all the markets are the same, and I'm going to treat them the same. In order to get that sample size, this is what I have to say to myself. And then someone comes along and says, well, everyone knows that shorts are different than longs, or everyone knows that, I did another thing that I really enjoy is that some of the CTAs, they look at the individual Sharpe ratio of a market. We just all live on such a different planet, Yeah, they're looking at the individual, we look at the Sharpe ratio of an individual market, and then we're going to decide something. I don't know, weightings or something. It's just so foreign to this classic turtle trend following that I just laid out about how to look at the markets and the sample size. It's really a different planet. And this is another fun thing too, with all of these differences that honestly I would abandon if there was good evidence for it. It's really fun with the stocks and the systems and the loose pants and the breakouts and doing as little as possible to see who's going to win in the end. I need to win. I need to be acknowledged as having this superior formulation of trend following. And if not, I'm going to be kind of bummed, because I look at it sort of like I'm the S&P index of trend following or CTAs. And, it's very hard to beat that index. And so it should be very, very hard for me not to consistently do way above average because of all these advantages I say I've given myself. Better systems, more markets, the stocks, no correlation management, no vol management. In my mind, I walk around every day and just can't get this smile off my face on all these big edges that I have. And to everyone else, that's silly. That's silly talk. So it's just going to have to play itself out and to see who's right. And I think I'm giving myself all these advantages, unencumbered, nothing to lose, no clients telling me to vol manage and correlation management, no one able to impact my ability to trade single stocks, my lack of desire to protect profits. I protect profits better than anyone by following that system.
Jerry, I'm curious about one thing. I think this is relevant to the conversation about indexes or individual stocks. I'm a chief market strategist, so all I do is look at individual stocks all day. But do you notice in your strategy implementation, do you see any coincident indicators or things occurring, whether your systems are going long or short a certain asset class or other asset classes acting, or indexes, are they acting coincidentally based on your strategy? have you seen that or tested that, or can you speak to that at all?
I don't think I understand that question.
Are you seeing sort of an edge, like if there's a regime change, whether it's interest rates or something of that nature, that you typically are long a certain asset class when an exogenous event happens external to your strategy? Have you seen any correlation to that over time?
Well, I probably don't look at the markets that way. And what I do see though is things will start hitting the news, and I have these stocks on my radar list like AI, and I've got specific stocks that I want that meet my criteria. Smallish, um, not a lot of different business lines, focused in on AI. And so I'll notice that am I already long? Am I going to start getting long? Are other stocks that I'm looking at in that group that fit my criteria, are they showing some strength? That happened recently with these I can't think what they call them, these electronic vehicles that and electronic taxis. So I had a couple of these companies I was looking at. I was long one. It starts hitting the news that one company's had success, and some of the other companies now are hitting the breakouts, and I'm doing these. So I'm just, believe it or not, totally focused on the first process is identifying companies that may have a chance for a big outlier, but also offer some diversification. Okay, there's a wall there. Don't ever think about that company again. Now, I'm just going to pay attention to it if it hits that breakout and it's time for me to buy it and follow my system. So I see the markets moving around, I see what's happening, but I don't really care about any connection to them. I treat them all as individuals. Um, and likewise, sometimes there's only a couple. These fundamental news is hitting the markets, and there's only some of the stocks are moving that I'm looking at in this particular sector. So I'm not interested in those. Yeah, I mean, like I said earlier, I think it's funny, that headline, billionaires are all buying CVS. And I'm like, oh crap, I'm short CVS. So I think that's funny. I'm just like totally ignoring any fundamental. I read the fundamentals, like why are they buying? I'm like, oh yeah, crap, it is a good bargain. And yet I'm just going to stay short and follow this system and totally not pay too much attention to anything fundamental. One of my traders said, I was talking about this issue of choosing stocks, and he was like, that's awfully fundamental sounding. I'm like, oh yeah, I have to pay attention to market cap, recent prices, the volatility, the liquidity, all that sort of fundamental, and what the company does, and is this a pure play in anything? Um, I get sidetracked sometimes because it'll be a company that's in a particular industry, meets all the criteria, kind of commodity based, and I'll say, oh, it's a good stock. Then I'll ask ChatGPT more information about this company. Then I'll finally say, does it make this product? And it'll say, no, it does not make the product. It does not mine it. It does not grow it. It does not make it. It just retail, it sells it. I'm like, oh, no good then. No good. It has to be making something, producing something, mining something, farming something. I'm a fiend on these food stocks, and anything to do with food, less than 10 billion, I'll probably have it. Mining, the different types of things that can be mined. I'm really focused on the commodity stocks, and they just look different. If you look at it from a trend following point of view, you wouldn't even know they were in the same business. And that's the only view I have.
Great. Appreciate that. Thanks.
Jerry, I do have a quick question for you. You were talking about Tesla being 500 ATR win. Was it your biggest ATR winner ever? Thank you.
I like to say 500, but it didn't, that was the open profit. And one of the great things about that stock too, that I try to remember is it made 50 ATRs right out of the gate, which is pretty nice. And it gave it all back. I think it dropped 49 ATRs. And then it just went straight up, but it was pretty choppy, going straight up and stuff. So that's one of the benefits of the loose pants and not paying attention to the open trade volatility. Because when you plug it into the computer and it does the back test, it says trade this system with this loose pants. You're going to make the most amount of money, certainly the most open trade equity in a trade. Not even a question. It's not hard to do. It's easy. But, of course, the hard part is how much of it you're going to capture. And it says, yeah, you're going to have the biggest drawdowns as well from open trade equity. You're shifting the risk of into this area that doesn't really matter so much because it's all profit. You're sizing the positions based upon capital, and you're preserving capital, but open trade equity is not capital. You're optimally handling them. You couldn't handle the profits better. And people accuse me, you don't care about. I care equally about losing trades and winning trades. I care more about winning trades than anyone. I'm following the back test that says this is the optimal way to handle those trades. So, unfortunately, we live in a tough world, but no one would be surprised that in order to make the most amount of money, you've got to suffer the biggest volatility possibly and a material drawdown. And it's very important. And this was kind of like one of the things from 1983 Turtle Class. And that is, they were trying to explain to us how humans want to avoid certain situations. So the example was market orders versus limit orders. And in a market order, it's going to just be worse. Over time, your fills are going to be worse. But they're never too bad. They're always, it's just a little nick all the time. You're always paying a bit too much every single time. But the human brain much prefers that over the limit works almost every time better, but sometimes it really fails. And so you have to keep chasing this trade all day long and moving your limit up higher before you finally get filled. And that memory, even though it doesn't work out mathematically, is far preferred from the human brain to not have that bad memory, even though you'll make more money by accepting that. Okay, I'm getting back to your question. So I don't know if it's the biggest, but it's definitely one of the best. But it might actually be, theoretically, like I said before, there are some big ones out there, thousands of ATRs in that first Bitcoin. And I think this is another thing that is so critical. And not only does the back test continue to tell all of us that you cannot be long-term enough. You think you're tough, you think you can have loose pants, but I'll guarantee you can't withstand the optimal look back of making the most amount of money and having the loosest pants. And so another part of that, though, and the reason it comes back to be so profitable is because of the ATR. That the minute you get out, you've got to get back in if it goes higher, and you've got to change that ATR. And trying to hold on to that initial ATR can be so critical. Another thing people talk about a lot is, do you have a time stop? If a market doesn't start making money in the first week or two or month or two, do you just sort of say, okay, I'm out? And I don't think that works well because there's been many trades where nothing happened for a month or two and you're sitting there with that huge position on and it hasn't done anything. But if you got out and then had to get back in later, the ATR would be higher. And trading with an ATR is very limiting sometimes, especially on short trades. But it is just the best when it comes to loading up on some big upside breakout and getting rid of that position. You got to think long and hard. And a lot of it is wrapped up in just an absurdly low ATR. Like I said, I think Tesla was 87 cents or something like that. And then, you put that trade on and it keeps going, and a typical day is plus or minus $50. And you're insane to keep that trade. Well, we're preaching, let the profits run, don't scale back to increase vol. It's dominating your portfolio. You're having these tremendously losing months. You're the only one having a losing month because of this stupid Tesla. And then, of course, at the end of the day, you end up making more money. So this is just a lesson of life. Can you put up with pain and suffering and relative underperformance short term in order to get better relative performance in the long run? This is stuff our parents taught us. This is how they raised us. This is how you raise children. Delay gratification, do the right thing. This is how our family is going to operate. We're not going to do those type of things. We're in it for the long run. Pursue excellence. Do the right thing every day. And then we get in professional life, and we get those computers going. We can find all kinds of shortcuts. And this is one of the things that people said this yesterday on the podcast, is that now we're so much more sophisticated. Niels wants to make it rules-based. It's all rules-based, as long as it's a rule. No, there's so many bad rules. And that's how when I used to sit in front of a computer or quote screen and do a discretionary trade and cut my profit short, well, that's just totally wrong. Now, if you program it in Python, I think it's okay. It's never been okay.
Yeah, just one final question. I mean, Absolute was talking about these global macro indices, right? I mean, he was pitching why you're not trading the indices. But isn't it, it is possible to be a global macro, having the global macro exposure from equities by trading single name stocks? I mean, isn't it just you can just trade, maybe you are already doing that, European stocks and Asian stocks, and you can put the entire indices to the bin, right? I mean, to answer his question, to Absolute's question, you don't need any of those indices because the single name equities will going to give you the same exposure anyhow. No? Thank you.
Well, I don't think I fully understand, honestly. I mean, this is kind of maybe embarrassing. But I know what words mean, and I can look them up, and I can, and I've been around, and I hear the same words. I don't know what people individually mean by them, though, sometimes. And I don't really think I know fully what this macro. I'm a very literal person, and people say things to me, and I hear them literally, and they don't mean to be so literal. And I need to know specifically and exactly what they're talking about. And I really don't understand this term macro. I mean, I could guess, and I'd probably get it right, but I need something way more concrete. If there's a macro future somewhere, I probably would own it. But I have a fair amount. Once again, you can see my stock positions, and the ones I'm long and short. But in some of my non-U.S. stocks, I guess I'm flat. But I have some non-U.S. stocks on and in the portfolio. But one of them is the salt company, and then one of them is a miner. I had a chocolate company at one point, and I have a handful of these, but I've chosen them based on they mine salt, or they mine uranium, or they mine lithium. So now you're also picking up something called macro. Okay, whatever. Yeah, whatever. That's great. Fantastic. Just something unique going on in one of these countries that's lifting all the stocks, like Japan had a big run up. But in my mind, what's running up that index is there's some stocks in there that have some fundamentals that are dragging everything up, just like NVIDIA and Microsoft is dragging the S&P up. There's this, and we always talk about this, the FANGs and this big dispersion. And so I guess there's a macro element too, but I don't think I'm smart enough to eliminate it or identify it and take advantage of it. So I'm maybe getting some benefits that I'm not even looking for.
Well, just trade the thing.
I'm trading the things. I think I haven't done this research, obviously. I'm not interested in doing it, but someone needs to do this research of testing. It's to be difficult since the S&P constituents have changed, but someone should just do the back test of trend following 500 S&P stocks. There's so many choices you'd have to make as far as the weightings. Do you go short, and things like that? But what do you do when companies come and go? and compare that to the S&P 500 buy and hold or the S&P 500 trend following. But that would be a good project to sort of. But like I said, I think you can vastly improve your stocks. It'd be sort of similar. It'd be sort of similar to saying, I'm going to trade bond futures and currency futures, but only the largest ones. Only the biggest ones. And everybody said, why are you doing that? It makes no sense. Although people do that. Eric kind of does that. Eric weights. I don't know how he does this because he maybe it's I guess in unit size. He uses the ATR for crude and the ATR for heating oil and ATR for unleaded, for instance. But his unit size for crude is much larger than heating oil and unleaded because he weights the markets based upon their liquidity or volume. Yeah. Go ahead, Oleg.
I wanted to say only that if we compare, and I have said this before, if we compare SP 500 buy and hold and SP 500 trend following, the trend following, our trend following program, it looks much more better, I think, to every person because it's safer, it has better performance. And I think in a long-term horizon, of course, lower drawdown. So I think it's not a misunderstanding. People don't understand all these benefits of transform. So it's surprising me. This is surprising for me that buy and hold strategy is more popular among the investors because trend following looks better in everything, and I think the person, it's not necessary for him to be a very smart investor to understand that trend following looks much, much better. I think so.
I think the premise that we start with is we're allowing for different components, in this case single stocks, to contribute in a way that trend following is, why it makes money in the first place. It makes money in the first place because there are unpredictable moves, and we don't know where they're going to come from next. We don't know which direction they're going. Now we can try to organize it. Indexes try to organize it into their own system, their cap weighted, long only system. And you might say, well, okay, we have 150, where do you go? 50 stocks, 100 stocks, 150, whatever, all the way up. And might say, well, yeah, these are kind of correlated. They're all in line. We're not really seeing much difference. We've been trading the single stock system for, say, a couple of years, few years, whatever. And comparing that to the indexes, we're not really seeing much difference. Yeah, you haven't seen it yet, until something goes haywire and something goes off in its own direction. Then we're able to capture it due to the, ATR based position sizing, and we're also able to extend our universe. What we're choosing to trade in the single stocks outside of the indexes themselves. A lot of these stocks, we trade are not in any major index. They're too small. So you talk to a trend follower, who's been in the business a long time, and we could just challenge them all day. Say, why do you trade all these metals? The same damn thing. Mostly they're the same damn thing. You're getting in and out around the same times. Not seeing much difference. Yeah, until New York Harbor freezes over and fucking heating oil is going nuts, and the other markets aren't doing much of anything. Yeah, Or the Hunt brothers trying to corner the silver market. It's like, well, yeah, most of the time it's kind of gold. It's kind of similar to gold. Yeah, until the Hunt tries to corner the silver market and gets killed, and then silver goes way out. So it's the same idea with the single stocks. Same idea.
Exactly.
Company,
and it's ironic that trend followers have to do these back tests. They have to have this systematic approach. They have to have these rules, and yet I'm I I do those back tests my entire career. And yet I've also learned is don't pay too much attention to the back test. Take as little from the back test as possible. And then we're like the same way. We're like trade all these markets. We love diversification, long and shorts, all the commodities, currencies, interest rates, a lot of stocks. And then we say, well, yeah, but we're not going to look at correlations too much, and we're not going to look at and we're just going to trade them all, and we're hunting for the outlier. And the diversification serves the purpose of finding more outliers and not primarily for the smoothness element, although I like the smoothness element. And so there's all sort of these seemingly contradictions, like, and that's the ultimate and the essence of it is that stop paying so much attention to this analysis and this back testing. And that's what I want to prove. Like, I've got these stale systems out there that we're not changing. They have no bells and whistles. And they're just following the trends. And they're letting the markets have these huge drawdowns. And let's see what happens. Let's see who can beat this sort of index approach with the only thing we have going for ourselves, which is the ultimate edge. And that is all these wonderful markets. We have more of them. They're better curated. And they're the ones that are going to have these huge outliers that I'm going to have nothing to do with, except I just didn't F it up. I got in it, and I didn't get out too quick.
Can I make a prediction? 10 years from now, TN is either going to kick it out of the ballpark, or it's going to underperform trading indices, or it's going to underperform CTAs, and its equities, 50% equities trading is going to underperform trading global index futures. And it's purely going to be based on the choice of the current 150 stocks. So if it kicks it out of the ballpark, Jerry is going to accept the gold medal and say, see, I was right. Everything I says just happened. And if it underperforms because of the stocks maybe rallied, maybe there were outliers in the other 3,000 or 5,000 stocks, and this 150 just didn't have them, but it's 50% of the risk exposure, so it's going to be significant. So exposure to this random selection bias, which is 50% of the portfolio, it's turning this into a coin flip 10 years from now. And if the coin flips in Jerry's favor, he's going to seek that as a validation for his approach. And if it doesn't, if it underperforms CTAs, and because it's so much equity exposure, and if the equity part underperforms trading equal amount of risk of global equity futures, then Jerry is going to say, well, yeah, I was right, but I just picked the wrong 150 stocks. Look, if I had picked these 150 stocks, then I would have outperformed, or if I had traded the indices, I would have outperformed or performed the same. So this is my prediction.
I think some of that I can agree with. I mean, I don't think it's going to be a situation where I don't think I'll underperform the next 150 on my list. There's no perfect 150. I'm very happy with my philosophy. So of the 300 stocks that I love the most that fit my philosophy, I've only chosen 150. I'll definitely do just fine compared to the other 150. It's kind of a random thing. But because I've sort of chosen these stocks using a trend following mentality to hunt the outliers and for diversification purposes only, then I could easily underperform the S&P because what has worked so well are these tech companies, these large companies the FANG type performance that carries the whole S&P index. And so I have no coverage for that at all. So it has definitely crossed my mind for the reasons that Alp has mentioned, and that particular reason as well, that what would happen if I traded some indices as well, because I really don't have it covered to compete against the indexes if this formula, this FANG-like performance continues. And it's continuing today. It's doing really well. I've sort of tried my best to turn these stocks into things that look more like commodities. And now I think it would be difficult for me to underperform the other CTAs, certainly not as relates to the systems I use. I will not underperform due to the systems. The only way I'll underperform is being judged under Sharp. I will perpetually underperform, judged by the Sharp ratio. But having too many stocks, I mean, yeah, that's definitely a risk that my commodities could do pretty well, but the commodity-related stocks won't do well. And then you could have just a golden age of currencies and or interest rates, and my allocation is smaller. But I think my chances of doing well versus diversified CTAs that don't trade single stocks is lower than I probably do have a. And then buy and hold. Buy and hold works so well. Recently, over the past 10 or 15 years, we've had an inordinate amount of trend following failure as it relates to the indices because of these V bottoms. They crash, and there's not another 2008. It's a COVID rebound where the CTAs get short late, get out of the longs late, get short a little later, and then by the time they have a small profit built up into short, it just V bottoms and rebounds. I think that obviously trading individual equities is better in that regard. But yeah, I mean, there's definitely some situations where I don't have I say I have your stocks covered. Let me trend follow stocks for you. I have a material amount of stocks in my portfolio. You won't miss out on stocks. True enough, but like a lot of people in this who trade small caps and who trade different strategies in the stock world, I could definitely be in their camp as well and continue to underperform the S&P. I don't know if it's ever going to. Maybe this is just something that's going to last forever. That the largest and biggest and the tech companies do really well. I don't think the S&P, it's relevant, honestly, that this sort of argument that the S&P is kind of a trend following system itself. If it is, it's very poor. And it's not robust and consistent applying a set of rules. And not even to talk about the idea that by the time it added Tesla, it was deep into that trend. So the random nature of adding stocks to the S&P compared to a systematic trend program that uses breakouts and moving averages is not even a reasonable comparison.
But the difference, Jerry, is that the index will inevitably add whatever new is happening and whatever is being accepted as a new phenomenon or something. The problem with keeping a fixed universe of 150 stocks now, like Tootsie Rolls, miners, 3D printers and whatever, because now you know in the news what's popular, what's kind of in, and you kind of try what to diversify. But what if in the next 3 or 5 years, 20 or 50 new companies pop up? They're doing cold fusion or superconductivity on room temperature. And so then you will read the news, and when the trend comes, you will see them move. There will be in the news, oh, this stock went from $1 to $100. It's going to be interesting to you. And it's going to be, oh, it's decorrelated with my miners and stuff. I may just add them. So the process of you keeping up with how the world is changing and not keeping your 150 stocks stale, where Tootsie Rolls just becomes inconsequential. basically. And there's another thing that you cannot accommodate is, what if Tootsie Rolls decides that to pay out all the dividends to its owners? So let's say it's a $20 stock and it remains a $20 stock. There's no growth. It keeps making consistent money. It has a 5% dividend, pays all the profits to its investors, and it's a $20 stocks for the next 20 years. It's a successful stock. Investors are getting their money out, 5% in dividends every year. But you, as a trend follower, you're looking at a $20 stock that fluctuates between 17 and 23, get whipsawed till no end. And at what point you decide, you know what? Tootsie Roll logically is very different from the miners and stuff, but it sucks to trade with my trend following system. How do you handle that? And especially because you don't care about backtests.
That's not fair. I like backtests. I do a lot of backtests. I've done a lot. I like to look at them, but I'm just trying to look at them with skepticism. Now I do have Tootsie Roll, and it is 1 out of 150. So you could probably ask me a lot more questions how I'm going to handle something like that, and I haven't thought about it. But and I forgot. Crap! I forgot the first part of your question. Oh, I know what it is. So I think from a trend following point of view, what's driving the profits of these companies, of any market, is the trend following itself. We are creating profit. You know, they have this situation where they run these studies where the buy and hold, 4% of the stocks make all the money in the buy and hold. But if you use trend following, 94% make money. So it's the trend following that's generating these returns. And as we've said many times, and Richard has said, all these markets have this similar ability to create these outliers. And some of the companies that as I said earlier, that I trade have been around for a long, long time because they're just making things. They're manufacturing and producing and farming and mining and creating products. And so they're very, very old. And so they'll eventually have some sort of trend, maybe an outlier, and the trend following will capture that. So that's how we're generating profits, not from companies doing things, but from inevitable trends that occur in all of these markets. And I think any bad thing you could say about a company, I think about this a lot. I don't see how you couldn't say the same thing about a commodity or an interest rate or a currency. Sometimes it makes a lot more sense to me that stocks trend than currencies, especially when you go through these long periods where some of these sectors don't really trend very much. And I'm very hesitant, and I've tried to be very clear about this and remind people over and over that here's what I'm thinking. And then something happens in the markets and you have a big trend and it's in a stock that I had that does not fit my criteria. And I've tried to say, do not listen to all this logic because sometimes these trends, I never would have thought that my biggest trade of the year would come from a perfume company. I don't know. I was just joking around and put it in there and said, yeah, let's have some perfume and cosmetic company. I don't know if I would put it in there today. Oh yeah, and this one in particular doesn't do a lot of its own creation of the product. It's more retail. There's other ones out there that more develop the product, and so I feel like that's better than just selling the product. I don't want to have retail stocks. So anyways, I probably would not even have that one today. I probably will kick it out eventually. So, but yeah, I'm just relying upon the trend following nature. All of these markets can have big trends. I'm trying to tilt it in my favor a bit. I don't want to trade companies that are very diversified that remind me of an index. I want 300 markets that offer no diversification until I put them all together in my portfolio and wrap trend following around them, and I create the diversification. But I think trend following is too powerful sometimes to put it in that particular box, Jerry's box. and because it can explode out of there, and we can get major trends in very large companies with very diverse business lines. Maybe NVIDIA is an example of that. So I think trend following just has a tendency to work far beyond even what I anticipate. All right. Okay, so we went 3 hours, and that's at some point that's all I could go for. We got to go for 3 hours, and probably because some people tuned in at 8 o'clock, and they've only been here for 2 hours. Richard, I'm pretty sure, is not awake. And so, okay, absolute. You got to commit to me. You'll be here at 7 o'clock next week. No excuses. You have an iPhone. I have so many alerts and alarms set on my iPhone. Set an alarm on yours, so we can hang out again.
No, I'm in Europe now, so my time is a little bit twisted. So
That's right. That's right. Oh yeah, I'm going to Europe soon, so I'm going to have some different time zones to deal with as well. Okay, let's keep the tweets going, direct messages. Have a good weekend, everyone. I can't ever promise we'll do 3 hours again. I missed so many other meetings. Okay, take care. Next week.